check. Bismillah ar-Rahman ar-Rahim. Assalamu alaikum wa rahmatullahi wa barakatuh. Respected dignitaries, honorable guests, ladies and gentlemen, good morning. On behalf of Bahrain Fintech Bay, the Bahrain Institute of Banking and Finance, BIBF, the Bahrain Insurance Association, BIA, I am delighted to welcome you this morning on day 2 of InsurByte 2019. My name is Amal El-Sorani and I'm delighted to welcome you all to today's proceedings. Thank you all for your attendance with us this morning. InsurByte 2019, as an interactive learning platform, brings forth unique concepts on the importance of merging technologies, the latest technologies, with the classic operations of insurance, and invites us all to reimagine insurance, as the slogan states, to include innovative digital solutions that will definitely cause disruption in the future. On today's agenda, we bring you a whole set of unique perspectives focusing on the importance of insurance technologies, or InsurTech, and how these innovative digital solutions are reshaping the insurance landscape. With the theme of the summit being Reimagining Insurance, our speakers and panel discussions will shed light on business model innovation, claim handling, payment automation, insurance disruption, the role of AI, amongst many other topics. I would also like to bring to your attention that we bring you the power to interact with these discussions through the hashtag InsurByte, on Twitter, and of course on our account. You can also follow the account for more insights and more nuggets of wisdom. And now we commence with a few words from the CEO of Bahrain Fintech Bay. Please join me in welcoming Mr. Khalid Al-Saad.
Well, ladies and gentlemen, good morning. Delighted to have you back here for the second day of InsurByte. I don't want to take much longer of your time, but I think reflecting upon the first day that we had yesterday, speaking to a lot of people actually, and I think the feedback was that there were some new ideas and new thought processes that companies really need to think about, especially in the insurance industry. And I think not only the demystification of blockchain and its implications on the insurance sector, but also cloud policy and how it's positioning itself, the regulatory challenges that are still potentially impeding the rise of InsurTechs and the adoption, digitization in the insurance sector. I think today's sessions will be quite important also in terms of understanding it from a payment side of things, understanding it from an artificial intelligence side of things, but I think also more importantly, whilst individual institutions think about the way they want to move forward and how they reposition completely their businesses, I think it's very important to understand and see how you can meaningfully work with fintechs to really activate these partnerships. And I think if there is a key takeaway, I think out of this, aside from thinking about how to move forward, connect with the customer and better understand how to run your operations, is taking that opportunity to really connect with the fintechs or the insurtechs to understand how they're thinking, but also at the same time to potentially take these partnerships or discussions forward. So I just want to wish you a fruitful discussion. I want to thank you all for all of your support, and I look forward to a fruitful day with you. Thank you very much.
Thank you, Khalid. Proceeding with our agenda of day 2, we start with session number 1, entitled Business Model Innovation in Insurance by the CEO and co-founder of LACA. Please join me in welcoming Mr. Tobias Taupitz.
Hi, good morning. I'm Toby, the co-founder of Laka. Laka is the Hawaiian goddess of prosperity and hula dancing, as you might have guessed. I'm not asking you to do the hula dance with me today, maybe another time. I'm here to speak to you about business model evolution. I think it's urgently necessary and required to invent a new business model in the insurance space that is more closely aligned with the customer. You all know the conventional insurance model, where insurers take premiums up front and more claims means effectively less profit for the insurance company. I think that's been going on for a long time, and I think there's a way to do it slightly better. The outcome is the same, cover for insurance clients, but in a different way, assembling the value chain. We've seen a step up in the insurance business model evolution in the form of peer-to-peer insurance. They would still run on actuarial business models where you charge premiums up front. However, they would take a fixed fee for their services, and they are indifferent to paying out claims. In our world, Laka actually turns it around. We charge premiums at the end of the month in arrears based on the true cost of claims. We move away from the actuarial principles and say, I don't know how many claims you're going to have this month. Why should I charge you £100, dollars, or what else? We say we only send you a bill at the end of the month once we know what happens. A cost-plus insurance model that is in the making. To reiterate, we no longer charge premiums up front. We put ourselves in the really uncomfortable situation where we charge at the end of the month and incur credit risk, no more underwriting risk. We say, let's go all the way, provide a good service, and charge money later based on the true cost of claims. We also have our interests aligned, because how we make money is by adding a fee on top of the claims payout. If there are no claims in a month, we wouldn't earn any money. But we say that's the right way of going about it. We make money when we act in the customer's interest. And of course, that allows us to be fully transparent. Each month we send out a bill telling the customers, you 1,000 people had 10 claims, now please, please, please pay me £3 this month to recover my costs. And with that, it forces us each and every month over and over and over again to provide the best service possible to customers, otherwise they would run away and not pay their bills. Now, let's jump into how the model really works. When you come to our website, you would get a quote based on your insured value. We give you 2 numbers to begin with, instead of 1, as you have currently with insurance premiums. We give you a personal cap, a maximum price you would pay with us in any given month. That is guaranteed by an insurance partner, which is Zurich UK in the UK. And we tell you, even if all the things get broken, stolen, or lost, you never pay more than, in this example, £58. That's a theoretical number because we show them also in green what they're actually paying with us. Over the last 6 to 12 months, they would pay £28 on average. So it's a little bit like an investment fund where we say on average the past 10 years customers had a performance of X. And we tell them budget with that. If there are claims during the month, we would pay out swiftly because we have working capital in the form of a claims float from our partner Zurich UK. To leave that thought with you, there are 2 ways of how Zurich is monetizing to our partnership. We pay them a fee for the stop loss to cap the customer's exposure, and we pay them a fixed variable fee for the working capital. We offer fee-based income to insurance companies where there's currently underwriting income. We are an insurance intermediary controlling the value chain, and we are working with the insurer on the balance sheet or some requirements. So if there's a claim, we would pay out swiftly. We have claims authority, and at the end of the month, we would add up all the claims and split the cost of claims plus our fee in the risk pool on a pro rata basis. If you have a £10,000 item, you pay 10 times the amount of £1,000 item. And with that, they would get a bill like that every single month. And with that, we introduce accountability because we need to tell them what happened in a month. And if you have to pay a bit more than usual, it's because you guys had claim. It's no longer me lining my pockets. It's really telling them, if you guys take better care and play fair, you save money. That's the incentive we want to foster in this insurance model. To contrast and compare once more, we have the conventional insurance model where the insurer gets paid first, and we have the Laka model where the customer gets paid first. We have the conventional model where more claims means less profit. In our world, more claims means more profit. We have turned the claims center to a revenue center. And of course, the underlying business risk I touched upon briefly. is credit risk for us. My biggest business risk is that you run away without paying after having received a service versus underwriting risk conventionally. And I think what's really powerful in a crowd-based or affinity-based product is the community-based approach around risk pooling. We're no longer grouping people with a washing machine, an iPhone, and a bike. We say a group of people like yourself. And with that, if you cheat on the group, you're cheating yourself. Versus an anonymous risk pool, and it goes all the way to going to a conference, asking people, how do you feel about sharing cost of claims at the end of the month? And the person saying, I don't want to pay for other people's claims. He was not aware that insurance is about mutualizing risk. You're all in this together. For him, it was me against you. And if I inflate my claim slightly, I don't want to say fraud, but inflate, then it's basically a gentleman's crime, so to speak. So I think it's really a way to reinvigorate incentives in insurance. But can this really work? Obviously, is the elephant in the room. And I brought some statistics and figures with me. We have launched this product in January 2018 in the UK. And we have launched with a first use of proof of concept, which is cover for high-value bicycles for theft, damage, and loss. Our average policy value is £6,000 at the moment, so it's really ambitious cyclists to take out our product. But that was just a start to convince the regulator, to convince insurance partners, to learn from our customers how they feel and think about it. But it goes much, much more beyond that. And I asked my team to come up with a slide to show what we could do in the LACA model. And they sent me something like this. This might sound vaguely familiar to you, but it's actually true. We can do all of these things in the LACA model. Short tail risk, we like high frequency, low severity products. And we are looking into launching personal accident, dental, travel, home insurance, all that works in our model still. And we're tackling them one after the other. Now, this is now a statistic, which is actually real data showing how much a customer has paid with us the last 16 months. You see the blue column, £18, is what a customer paid on average in the market in the UK to insure the 2.2K bike. The pink bar is actually how much they paid with us in comparison. You see a couple of swings, sometimes a bit more, sometimes a bit less, but the message is clear. If you pay more, it's because you guys had claims. We were there for you and paid out. And with that, accountability is on to you. Of course, arguably, in the beginning, our risk pool was rather small. We expect the volatility to narrow each month with more customers joining the pool. Again, credit risk. Can this really work? There are so many case studies in the credit and lending space. Why shouldn't you be able to manage credit risk in the insurance space, provide a service first, and collect money later on? This is now a chart. In the 16 months of trading, we have not had one single customer not paying up at the end of the month. Through pre-authorized payments and credit cards, certain checks we do upfront, automating the billing email and the processes, we had every single customer paying up, at least after reminding them. And as you can see, the pink bar, it took us a little while to get there. In the beginning, 9 out of 10 people paid up immediately. We are now at 99% at first try, pay their bill. The other need a slight nudge, and then they pay up as well. So if you can manage credit risk, why not introducing it across the sector? I know it's really uncomfortable. Insurance is all about positive cash flow. I take the premiums in, I work with it. But if you think about it rationally, why not doing it the other way around? Force yourself to provide a service and take the money later on. This is now a statistic around how our stop loss works. We have set the stop loss, the personal cap, at market rate. So everything above market rate, Zurich takes up infinitely. We pay them a fixed fee for that every month for that service, almost a derivative, but the customer really values that and appreciates that. They want the certainty that they'll never pay more than the £18 I mentioned before, but again, we have never gotten even close to that and have fared at around 50%. Actually, 2018 alone, customers have saved 60% in premiums compared to competitors in the UK market. Now, we've launched this product against the odds. We are very fortunate that we have a very thriving ecosystem in the UK, including being part of accelerator programs, regulatory fintech sandbox, and of course, Knowledge Partner EOS Venture Partners is also helping us along the way. But what's quite interesting to me, and that's also a reason why I'm here today, is towards the end of the timeline. We have geared up and lined up a lot of support in Southeast Asia and we are aiming to launch Laka in Malaysia later this year. And that is because it was occurred to us, it was pointed out to us that our model might have strong applications in the Takaful insurance space. We had initial sign-off from a scholar in this region, and Malaysia and the regulatory fintech sandbox were quite welcoming to test it out. A lot of open questions, but again, I'm here today also to speak to as many people as possible among you to understand what the use case could really be and how we could work together. And again, to reiterate, we are partnering with existing insurance companies. We offer fee-based income for the stop loss, for the working capital, and we basically take care of the rest. Now, we have launched and built our in-house tech platform end-to-end. We control onboarding, administration, and claims handling, have claims authority, and only send once a month a risk bordereau to our insurance partners. There is no lengthy integration. It's ready to plug and play, and we can launch new products within weeks with the right partner at the right pace. We are quite proud of our claims experience because customers actually file claims online. They go to their laptop or their phone, they file the claim, we ask for video statement, tell me what happened to prevent fraud. We ask for pictures where we read out the metadata, for instance, to verify it. And if customers want to, they chat to us to a web chat. We don't have a landline because we believe we can provide a much better service to a web chat, not having the customer sitting in a waiting line for minutes or hours sometimes even. And clearly, bikes is a black and white binary product that allowed us to pay out claims in as little as 30 minutes because, again, we have claims authority and can do what we believe we can do best. And actually, bikes might sound like a silly use case to begin with, but to put this in context, there are roughly 6 million bikes in the UK worth more than £750, our sweet spot. We only start at that level to avoid the commodities and the low-value bikes, the pub bikes they are often called. They are left unlocked. But there's a really thriving ecosystem for data, and we are collecting all of the data points in the background to learn. And 2/3 of our customers nowadays log actually in via social media platforms, one of which is Strava, a cycling platform where cyclists track their ride-outs and grant us permission to read out their data through an API. So we can actually look at any point in time where in the UK our customers cycle. Now this is a map of around 30 days of data where our customers, our risk pool is actually active across Europe. Luckily, we are a UK company and they're all in the UK mainly. We do offer 60 days of travel, so clearly they would also go abroad to cycle in France, Italy, Spain and whatnot else. But again, we can see, do we have a risk concentration problem? Could there be collateral damage? And I'm quite pleased when I see this chart that it's actually quite spread across the UK. But we can actually really drill in to see where in the UK are these guys cycling. So we see the main hubs, of course, between London, Birmingham, and the north, Liverpool, Manchester, but of course some more rural areas. And I wanted to, and really understand what's happening in that risk pool, I would just zoom in a little bit more towards London. And if I'm really keen, I would go to a certain area within London to understand where have people cycled over the last 2, 3, 4 weeks. We are not doing that for fun, partially maybe, but also because we want to learn from that. And we are building towards a behavioral risk scorecard that's moving away from underwriting by the postcode. In my mind, it's all about how you guys behave. That is how you should pay and be charged and be grouped accordingly. So we collect a vast amount of data in the background, starting with behavioral data, where you have claims, and there's the platforms I just mentioned, where the bike is actually riding across the UK. We have passive data, like social sign-ins, how they connect within the community, referral schemes they are using up. We use proactive data, how complete is the profile, do they interact with certain offerings we have, it's called Laka Club, a membership club for instance, and how frequently they update their profiles. We actually allow for real-time adjustments to the policy. In any point in time, you can come to our website, our web app, and add a new bike, take one out, add accessories on top, and people really love playing around with that. If you have a 5K bike and you buy a new saddle, for instance, you want instantly to add 200 pounds more on cover and not waiting until your next renewal a year later, for instance. And lastly, some more objective data around bike value, numbers of bikes, where is it stored, etc., etc. And that all is taken into consideration and it's effectively building a behavioral risk scorecard which allows us to group customers not just in a new joiner pool, but we're going towards a silver or gold pool, where we really tell your group with people like yourself, the ambitious cyclist who's taking really good care, weeding out those who are trying to game the system or a bit more sloppy. But if you go the extra mile, share a bit of more data with us, we put you in the silver pool with the proven better risks who should have less claims and you pay less implicitly. And on top, we lower the guaranteed rate, the stop loss in that regard as well. So again, whilst it's a niche, those niches really allow us to really dig in, consume vast amounts of data, and have a good assessment of what's going on below and beneath. I want to conclude this with a few key takeaways. So clearly, if you start from scratch, leaving the path of the known, so to speak, you can build a business model that aligns interests in a very different way. Our customers really appreciate, by way of feedback, how they actually are told what they're paying for. They like that insurance has become a tiny bit more tangible by learning that the claims they put in has a direct correlation towards the claims payment at the end of the month. They really like being part of the affinity group. And we have some early evidence, which is really interesting, where people say, hey, I had a claim. I don't want to burden the community with a minor scratch on my frame. I'm not going to put in a claim. And they say that, and what was really interesting, I don't want to burden my fellow insured people. And I think that is what a lot of the peer-to-peer and crowd-based solutions want to foster. It's the way of losing the me against you attitude towards the insurer-customer relationship, but really starting over altogether. And of course, the analytics part I talked about was really there to weed out the bad apples, so to speak. They would be caught in the new joiner pool I mentioned before, and let the good ones rise to the top. It's all about being proactive, or at least playing fair and along. And I think as a last word, again, I'm here to learn. I would love to speak to you to see if there's any way of collaboration in the future to work together now or later. Again, it's a plug-and-play solution, and with the right partners, really interesting to learn what we could do together in the Gulf region. Thank you very much for your time.
Thank you very much, Tobias, for your valuable insights. Next up on our agenda, we bring you a fireside chat about claim handling and payment automation. Please join me in welcoming onto the stage the Chief Executive Officer of NEC Payment, Mr. Andrew Sims. The Senior Vice President of Enterprise Partnerships from MasterCard, Mr. Ian Slater.
If you hold tight, I'll introduce you. Can I get some slides, please? Good morning. Thank you very much for turning out on day 2 to come and listen to us. I'm going to spend a little while giving you an overview of who Appiso are and the solutions that we provide. And then I'm going to introduce my colleague Ian Slater from MasterCard, who will provide some context on how we and MasterCard work together on the solutions that we provide. When I get some slides. So just while we're waiting for the slides, I was introduced as the CEO of NEC Payments. NEC Payments are a licensed and regulated entity here in Bahrain. We're a payment services provider and a card processor. And we've been developing new payment solutions over the last 5 years since we set up the company here in Bahrain in the consumer and the business space. We spent a lot of time focusing on B2B payment solutions in the travel industry to start with, and then had so much success in that industry that we actually created a new company called Appiso to represent our interests and help to grow our business in that segment. Am I going to get some slides? Sorry. So just to contextualise what we're going to talk about today, you've been hearing over the last sessions yesterday and this morning about new and exciting innovations within the insurance industry and how you can reimagine your core business. Now, to a certain degree, that's what we're talking about here, but also this is a much more practical, opportunity that we're talking about here that you can bolt onto your existing business. So when we're talking about the technology solution that we provide, it's not something that you need to reinvent the core of your operations. It's something that you can add on to the core of your operations as a last mile solution. And so Apiso provides automated virtual payment solutions, and we work in partnership with NEC Payments and MasterCard. And this triangle gives us a licensed and regulated institution as a financial services provider that's capable of holding customer money, taking deposits and providing payments across the international payment schemes. We bring the breadth and extent of the MasterCard network to power global acceptance and provide the ability for us to have a very broad reach to businesses and consumers that will accept our products and use them on the MasterCard network. And Apiso provides one brand at the front end that enables us to go and contract with customers in many different countries and add in other financial services partners outside of the Gulf region if we should to. So it's a locally bred Gulf solution which is exportable across the region internationally. The solution is proven in the travel industry. In the travel industry, we have built our secure and scalable technology to power B2B payments within the travel segment. So we have a large volume of customers around the region that are mainly travel agents and online travel agencies that use our technology platform as a way of making payments to their suppliers. So travel agents will pay hotels, will pay airlines for the tickets that we purchase from them when we travel. Those payments can be made in multiple currencies, and they can also be made by multiple channels. We're a technology company and we provide a range of ways for those travel agencies and companies to work with us. They can integrate their booking systems with us directly via an API and completely automate the process. They can use a web-based portal, so if they have ticket desk staff that are working in a call centre or working in a retail environment, they can use our web-based platform. And also, we partner up with international global technology solutions like the GDS systems, Sabre and Amadeus, so that customers are able to access our payment products by making bookings through the tools that they use in their day-to-day business. So it's a very flexible solution that enables us to adapt to the way that our customers work rather than expecting our customers to adapt to the way that we want them to work. And the solution that we provide and have been providing for nearly 2 years now provides measurable benefits. It enables our customers to reduce cost, it improves their operational workflows, it automates reconciliation and exception handling to improve their financial operations and financial control. And importantly, it drives new revenue from incentives that we're able to pay to our customers for using our platform. And those incentives coupled with cost reduction makes a healthy difference to the bottom line of our customers. So I can see you sitting out there thinking, well, this is all very interesting, Andrew, but we're in an insurance conference, so what has the travel industry got anything to do with insurance? And this really comes into the story of how we're developing the business. When we started to build our product and get some traction in the travel industry, we realised that looking at other business segments, that if you disregard the industrial segment, and if you change the payor and the payee, and you just think about the process of making a B2B or a B2C payment, then there are lots of similarities across multiple segments, and insurance is one of them. When we think about B2B payments that are made by insurance companies, there's a very high volume of payments that are made by insurance companies to suppliers for motor and medical claims, for travel claims in particular. And in those cases, some of them may be domestic, a large portion of them may be domestic, but there are also international payments that need to be made in multiple currencies. So there are a lot of similarities between the experience that we've had in building our solution in the travel industry and the insurance segment. Claim settlement process is complex and time-consuming and ultimately relies in multiple administration stages involving both the payor and the payee, and in many cases an intermediary like a TPA to be able to run that process. And by using our solution, we can greatly reduce the amount of administration. By reducing the administration, we can increase the speed to claim settlement, get suppliers paid earlier, so suppliers can provide a higher degree of service to the customers that are making the claim. We can enhance productivity within the insurance company and the TPA by reducing the large burden of manual administration, which is not required in multiple cases. We heard yesterday about how insurance companies are now improving business operations by focusing on the small number of cases that are flagged as possible exceptions and automating the large body of that. And our solution plays completely into that same methodology. And most importantly, it enables us to do all of this whilst maintaining operational controls and financial controls. And the bit that you'll be really interested in is that after working with multiple pilot customers through proof of concept stages, and these are anything from small TPAs up to organisations that are processing hundreds of millions of dollars per year in claim settlement payments, then we've done cost-benefit analysis that shows that we can provide a cost reduction or net profit delta of around 1% on the value of annual payments that are making. So if you've got a TPA that's processing 100 million of payments in each year, that's $1 million in difference to the bottom line that we can make by using our solutions. So how does it work? First of all, there are three main parties for us. There's a PISO that sits in the middle. We are a payment integration solutions provider. We're not a financial services provider. And so we partner with financial services providers to hold customer money and to be able to process transactions over the MasterCard payment network. So one of those financial services providers is NEC Payments, the company that we also own, that I'm the CEO of here in Bahrain. And we have our customers. And so when a PISO sets up a solution with our customer, our financial services partner will do due diligence on the insurance company, and the insurance company will pay money into segregated customer money accounts that are held by the financial institution. And all of that is managed and reconciled via the payments integration software that a PISO provide in the middle. When we're in operations and an insured makes a claim, the insurer will deal with that claim in the way that they would do up to the point where they're satisfied that they have a liability and that they need to make a payment to the supplier. Now, generally what happens at that point in time is the TPA will raise an LPO or give an instruction. They give that to the supplier provides the services. At some point, the supplier raises an invoice. The invoice goes back to the TPA process it. If they agree with it, they put it into a payment cycle. That payment then needs to be made to the supplier has to receive that payment and reconcile it. A huge amount of manual administration work and cost on both the payor and the payee and the TPA sitting in the middle. Where our solution enables the TPA or the insurer to do is to create a virtual card that's loaded with the amount that the TPA has approved and ship that to the supplier at the time that it would have previously shipped an LPO. That means that the supplier can then place an authorization against that card in the same way as they would do any other MasterCard and receive their money 1 to 2 days after the claim is approved, not sometimes 30, 45, 60, 90 days after the claim is approved. And you guys out there in the room will know about how long it takes you to pay your suppliers and the effect that that has on your and their business. And most importantly, it ensures that it makes sure that the insured is going to get fast service, because the supplier is always going to be keen to do business with you as an insurer, and they're going to settle your claims and deal with your customers, not refuse services, because they know that they're always good for the money. And from a financial settlement process, the B2B supplier will use the card in exactly the same way as any other MasterCard. There is no difference. So that gets presented using any sort of point-of-sale device or payment gateway solution that the insurer is providing. There's an instant real-time authorization against our partner's platform. And within that authorization, because we are controlling the creation of the virtual card, we're able to introduce security controls. And so if, for example, you're making a claim payment in-network to one of your known suppliers, we can reject a payment authorization if it doesn't come from the supplier that you've told us that you're paying. If you're making a travel insurance claim and it's for accommodation because someone's had a flight delay, and we receive an authorization from Gucci because someone's decided to try and buy a handbag with the virtual card, we can decline that transaction. So there's a huge amount of security and control at an operational level to prevent misuse, as well as the standard anti-fraud controls that you'd expect. And because we're capturing all of that payment data, we're able to feed all of that back into the financial control and reconciliation process, comes into our platform, we create that into a consumable format and share that back with our insurance partners. So if we look at a case study, this is a project that we're working on currently with a TPA that's working in the medical insurance segment. They are integrating their claims management system via our API so that when they create a claim and they know that they've got a settlement that they need to make, they can automatically send that instruction to us, and we give them the ability to also, if they need to modify that claim before raising a payment, to be able to make adjustments against that claim as many times as necessary and retain an audit trail. They then, once they've created those instructions automatically via API, they use our web-based portal to be able to control authorization of that payment. So we're not making a payment directly based on an API call. There is a multi-party approval process, and that can include multiple parties across multiple organizations. So for example, we could have a maker checker within a TPA, and then we could have a super checker within an insurer. And that's configurable based on templates. So if you have an approval matrix that says that 10 people, all in a certain specific order, have to approve a payment before it's made, then our technology platform will support that. We've dealt with exceptions on what happens if we've made a payment and your claim goes through an adjudication process and you realise that you've paid too much, or you realise that you haven't paid enough. So there's a concept of supplier adjustment accounts. If there's an exception, you can post an amount against an account that's held for that supplier, and when it comes time to make the next payment to that supplier, the value of the next payment is reduced or increased by the amount of the adjustment. We can reduce, with this particular customer, average time to claim settlement by a minimum of 30 days, often more than 45 days. That's enabled them to negotiate an early payment discount from their suppliers. We also pay them a cashback incentive based on payment volume, and in this particular case, the cost-benefit analysis that we've done indicates that that TPA can make around a 2% saving on the value of the payments that they make. They're processing around $10 million a month, $120 million a year. That's a substantial amount of money, maybe $250,000 a year that they're able to save on their bottom line. So these are real significant measurable benefits from something that doesn't involve you to do substantial changes into the core of your operation and can be bolted on as a last mile payment solution to your existing process. As I said, we work with MasterCard. MasterCard have been very active in this space internationally, and I'd like to introduce my colleague Ian Slater to join us to give us some view and perspective on how MasterCard have worked with, are working with us, and how they've worked with other payment providers internationally to drive this business through the insurance industry. Ian. Superb, thank you. Yeah, I think so. Not that close, I've only just met him. So, Ian, thank you.
Thank you.
So you're Senior Vice President within MasterCard's Enterprise Partnerships team. Perhaps you could just share with us, by way of introduction, your personal experience and what the Enterprise Partnerships team at MasterCard is all about and how you focus on different industry segments.
Yeah, definitely, absolutely. And thank you for having me, and good morning to everybody. MasterCard may not necessarily be an obvious person to be talking or appearing at a financial technology conference, and therefore it may provide a little context as to why we're here and why we're interested in this space. So really, we set the Enterprise Partnerships team up about 5 years ago now, five or 6 years ago, because the environment, much like the insurance industry that we existed in as a financial services company, was changing, and was changing very rapidly. And that we felt that our model and the way that we did business was perhaps not best suited for the way that the world was evolving. We wanted to be more involved in different sectors, we wanted to be more involved in different verticals, we wanted to kind of step outside of our traditional areas of business. but we didn't have the model to do it. So we set the team up to allow us to do that. And really what we do and we say enterprise, so we truly do this at global level, is we look for new businesses, insurance being one, where we can be relevant, and then we really provide a market making or a brokerage service where we bring together the traditional providers within that industry, and then the relevant payments and data and fraud and analytics tools from the wider market that can add value into that solution. Because one of the things we found is that there were a lot of companies who wanted to evolve, they wanted to innovate, but they didn't really know who to partner with. So we in a lot of cases play that dating agency role.
And so that focuses across multiple industry segments, but your specific role, I know, is now in the insurance segment. So perhaps you could give us, MasterCard's vision for how you're working in this particular space and some of the activities that you're working on right now.
Yeah, so we've been working on insurance for about a year or so now. I mean, MasterCard has a long history in insurance, so most of you, and I hope you all have MasterCards, will be aware that most of those come with some level of insurance associated to it, be it kind of travel insurance, purchase protection insurance. They have insurance processes associated to it. But that was kind of the end of our foray into insurance. And I think recently we have realized, firstly, that the insurance industry and the large-scale insurance providers are not actually that different than our traditional bank customers. They're large, international, monolithic financial services organizations who have been around for 100 and 200 years. We kind of understand that sort of company. Those are the people that we deal business with traditionally. But also, what we've seen is that the way that these insurance companies deal with particularly claims payments and customer services is evolving very rapidly. The digital environment that the consumer in particular is used to engaging with has meant that what they expect from their insurance company in terms of the way that they settle claim and the way that they respond to queries has changed. And the insurance companies have struggled to keep up with that. The traditional way of paying claim is slow, is painful, is not particularly digital. But yeah, that's not what people are expecting now. And therefore, we've seen that there is an ever greater call for people who can help smooth the claims payout and the payments experience within it, because it has become a customer service issue for these organizations. It is no longer a kind of back-end process that happens at the end of it. It's really part of the way that they present themselves to the market.
Yeah, indeed, and we can see that in many other industries becoming much more customer-centric than solution-centric. Now, MasterCard, we think of typically as being a plastic card that you pull out of your wallet to make a purchase in a merchant or even to do an ATM withdrawal. But there's actually quite a broad range of products that MasterCard provide in different formats. And I was talking during the presentation there about the way that we use MasterCard virtual cards for B2B supplier payments. Now, this is something new in this part of the world, in the Middle East and Africa region, but it isn't new internationally, and there have been companies using virtual cards in the insurance segment in the way that I've described in more mature markets for some time. Perhaps you could give us some indication of your experience in that and how MasterCard have worked with other organisations.
Yeah, absolutely. And really our journey into virtual card has been very, very similar to the APISO and the NEC journey. We started off in travel and we've moved beyond that. Virtual cards, and by virtual cards I mean just fundamentally the transmission of a card number across a payments network with a balance associated to it, so no physical plastic associated to it, usually for a single use of transaction, is probably the fastest growing transaction segment that we see within our portfolio. We grew something like 40% year on year from virtual card usage last year, doing a very significant amount of volume over the network for this. Now, in the insurance space, we're just starting to see that volume starting to ramp, and it's really being driven across a couple of different markets. We have a strong existing customer footprint using virtual cards in North America. Some of the large US carriers are using virtual cards for payment of claims, and now we're starting to see it ramping up in the European markets and a little bit in Asia as well. So one of the benefits that you see in virtual cards, particularly for a business-to-business transaction, it really only works for a business-to-business transaction, but for things like travel, for doctors, for hospitals, for pet insurance, auto repair, all of those categories, virtual card works really well because you have acceptance in there. All of those people understand how to process a card, they take a card, They understand the value of card associated to it. So there's no kind of educational process associated to it. So it's quite easy to add it in as a process on top of what you're doing today.
Yeah, and almost perfectly suitable for out-of-network claims where you don't have an established relationship with the supplier that you're dealing with. And I think it's good that you qualified there the B2B nature of virtual cards, because when we sit here and we think about consumers, in some cases we needed to make reimbursement payments directly to consumers. They're not carrying around MasterCard terminals, and they can't process transactions in the way that businesses can. But MasterCard still have solutions that can sort and solve B2C claims payments. There's a product called MasterCard Send. Perhaps you could just give us an overview of the MasterCard Send product and how that can be used for B2C.
Yeah, there's a kind of ongoing debate within MasterCard at the moment as to whether we should remove the word card in the brand. Actually, and if you look at the most recent branding for the company, for those of you who are kind of branding geeks, you'll notice that the word MasterCard has disappeared entirely. It's now just two dots. And really this is because as an organization, we're no longer focused just on card. We own an ACH in the UK. We run the faster payment system in Thailand and Singapore. We run one of the faster payments networks in North America. And increasingly, we're moving directly into business to consumer and consumer to consumer type payments, which is not a card-based payment. And Andrew, you mentioned the Send product. Send is a product that we have rolled out globally, which allows a business to push money directly to a consumer's bank account, as if it were a bank transfer, fundamentally. And we see a huge amount of application in this in the insurance space. It's already been well used. Companies like Allstate and Allianz use it in North America. We're seeing, again, some pickup in Europe, because what it allows you as an insurance company to do is to take a portfolio or a wallet-based approach. You can use the card for a B2C type transaction, and then you can use the Send product for card for B2B, Send for B2C, and you can cover the totality of your claims. And as an organization, really, that's how we're starting to think about this. It's not enough to just offer one type of payment rails, because there's not one type of payment scenario out there. You need to be able to offer this variety that respond to the particular environment and the particular needs of a business and a consumer at that point. Send pushes money in 30 minutes. So I think we had the bike example. Send transaction, once approved, hits the bank account in no more than 30 minutes.
Yeah. Yeah, it's very interesting. And so we found out that there's a much broader range of products available from the MasterCard network that gives companies like us at Apiso really the ability to solve a breadth of different issues and different payment use cases for the customers that we work with across industry segments, including insurance. So we've spoken a bit about product. We haven't really spoken about your experience of seeing the benefits that companies internationally are already realizing by using providers like Apiso and products that are based on the MasterCard Global Payment Network. Perhaps you could just give us an indication of how those companies are realizing benefits from these initiatives that you've described.
I think it's a question of reach. There are already only 2 global payments networks in the world. And I don't think there's anybody from my competitive organization, beginning with V in the room, but I would say that they are actually 2 networks. Still, they haven't integrated Europe into the wider network. We run a global payments network. We have somewhere around 30 million point-of-sale locations around the world, 3 billion cardholders, 22,000 banks associated to the network. And what that means is if you want to push a transaction through it, you have access to all of those endpoints at any given point of time. And the other point to note is that the network is not limited just to financial transactions. So increasingly for these more complicated and particularly business-to-business transactions, it's not enough to simply process a financial message across a network or to run settlement across the back end, both of which we do. But you need to be able to transmit data associated to it, and you need to be able to interrogate the transaction to make sure that it looks like you want it to look. So the network can take data, so we take information associated to the transaction, contextual information. That might be information directly related to a claim, it may be information related to fraud management. There are a number of different things that you can process alongside the transaction. So you get both financial transaction, and then you get the information associated to it, and you get it in 210 different territories around the world across a network that's been in place for the best part of 50 years. So I think we're pretty excited about what we can do here.
Yeah. And as I alluded to in one of the slides there, it's exactly the extent of data that we're able to rely upon from the MasterCard network that enables us to introduce the security controls that I was talking about and really protect this solution. So it isn't just a solution that provides added value benefits, it's also one that provides security and protection for operations as well. And so we've seen a variety of soft and technical benefits, and we were talking about the financial benefits that we've looked at through the cost-benefit analysis that we've performed. I wonder if there are any other final points that you would like to share with us around the benefits that can be provided, particularly from the technology, perhaps reconciliation and exception handling, and how valuable that data has been in your experience.
I think one of the two things that we found is most powerful. If I put our network to a side, but most powerful when thinking about partnering, is one that when you choose a partner in this space, you need to choose a partner who understands the industry that you operate in and understands the ability to associate payment to the back office systems of a given insurance company or a TPA associated to that. Because they're complicated environments. I think we had a guy from Roland Berger yesterday talking about the complexity of fintech and the fact that often insurance companies struggle to work out who they should be partnering with. It's very important that when you pick a partner, and we help people pick partners, that partner can properly integrate into what is often a legacy and complicated back-end insurance system. So we will help people find the right partners to allow them to do that, and there are a number like Apiso out there who do exactly that. So that's the one thing. The other thing is that claims payment, and I come back to the point I made before, payment on itself is not enough. Payment on itself is just is a process, and a relatively commoditized process. The biggest value that our customers get is the ability to contextualize that transaction. So both from a reconciliation process, so there are numbers, and there are huge numbers. Somewhere around $500 billion is spent on an annualized basis across industry just on reconciliation alone. There's a vast amount of money just on manual reconciliation or database reconciliation. One of the things that virtual cards and other types of payment products that we run, we allow that ability and we really smooth that reconciliation process. It takes money out of that system and money that can be used elsewhere. So not only do you get faster transaction, you get an easier to reconcile and quite frankly a cheaper transaction. So all of these things are things that we want to help the industry explore, we want to help the industry to benefit from, and we want to spend time with the industry understanding what it is that they see as pain points, how they see their world environment changing and evolving, and how we can partner. I have partnership in the name of the group I represent, and it's partnership that we're all about.
So thank you very much, Ian. It's very insightful. Thanks very much to the FintechByte team for organising the event. It's been fantastic. We have our Apiso team here if you want to just wave your arms around. If anybody has any questions for them, then we'll be very happy to meet you. So thanks very much for your time. Excellent.
Thanks, Andrew and Ian. Interesting perspectives there on automation in InsurTech. Our next keynote speaker will focus on partnering with InsurTech. The Chief Executive Officer of Hanover Reinsurance Group Africa. Please join me in welcoming Mr. Akim Klenert.
Good morning, everyone. It's a great pleasure to talk to you this morning. I've called my presentation Partnering with InsurTechs. And that's a very important point to start off with because I believe that in the InsurTech business is very different to other businesses that currently get disrupted. If you look at other businesses, whether it is a hotel business that gets disrupted by Airbnb or a taxi business worldwide gets disrupted by Uber, in the insurance industry, there seems to be a completely different trend. There is not really an insurtech that I have seen that disrupts the industry. It's much rather a partnership approach. You can even go a step further. What we observe at the moment is that the first insurtechs came up. They wanted to provide a whole business to the consumer, whereas the later insurtechs that are coming up specifically focus on pain points in the insurance industry and almost become like a problem solver or a consultant to the insurance industry. So that's why I think insurtechs are a huge opportunity and less of a threat to the insurance industry. What I will be presenting is an approach how to partner with insurtechs. This is the approach we are taking from a South African base. There are many different approaches and everyone must find their own approach. But I think for an insurance company not to look how to partner with insurtechs would be a big mistake. So you might ask the question, why somebody from South Africa talking at this conference? Well, the first answer to that is I got a friendly invitation, and because I'm a friendly person, I accept friendly invitations where I can. But the second answer to that is that what was called yesterday the insurtech jungle, I don't think it's quite a jungle yet, but that is just the South African insurtech landscape as it has evolved over the last, say, 4 or 5 years. So it is a very vibrant industry, and we are a very active player in this. So the companies that get circled here are companies that we do have an involvement with as the Hannovery Group. So I think we have learned some lessons already, and to learn lessons from others is always the cheapest way of learning. We do have a fairly unique business model in South Africa because we do have the reinsurance company, Hannovery Africa. We do have an insurance license that can partner with insurtechs by the name of Campus Insure. And then what is probably the most unique is we've got Lirias. Lirias is an investment company that for the last 30 years has done nothing else but invest in insurance entrepreneurs. So we've got a 30-year track record of doing that. There's a timeline here of businesses that we have invested in. Most of those businesses are still around. They are more traditional insurance business, not insurtechs, of course. Only in the last, from 2018 onwards, we're looking at insurtechs. But fundamentally, an entrepreneurial insurance business is not too different to an insurtech. Insurtech just adds the tech element. So in many respects, we look at insurtechs in a very similar way as we have looked in any entrepreneurial insurance activities over the years. We have co-founded 52 investments, but the most interesting figure is we've only had 7 investments that failed. So that's a pretty good track record. If you talk to private equity investors, they normally talk if 1 in 10 works out, that's a good statistic. Our stats are much better, and I expect them to be better because we focus on one industry. We only do insurance investments. So our knowledge, our expertise, and what we can bring into a partnership should be a lot better than if we were investing into just about anything that moves. Over the years, we have partnered with 10 different insurance companies. The one commonality for all our investments is always that there must be a reinsurance premium flow back to Hanover. But we do partner with insurance companies as they are best suitable for each individual business. And over the years, those entrepreneurial activities have generated over 2 billion gross premium. That's not a bad number from a small country. When we look at traditional insurance entrepreneurial activities, we look for 4 Ps. So the first and most important that we look at is who are the people that we actually invest in. We don't invest in business plans, we invest in people. because a business plan is normally only good until you launch, and then things change and you need to pivot and you need to adjust your business plan. So that's why we always look at the people. They don't need to be like us, but we need to like them enough to work with them through difficult times as well. We look at the product, is that in line with what we as Hanover Re would want to do? In terms of the potential, and that's probably one of the first differences that comes in from traditional business to InsurTech business, we look at the potential in a way that we want the business to become a commercially viable business. So they can be a small business. We don't mind investing in small business. I think the smallest business that we've got at the moment employs 3 people. They do a very specialized line of business, but they do it well, and that's okay for us. They're commercially viable. The largest businesses employ over 100 people. That's also fine for us. And then the thing that came in more recently is we also look at the planet. What is the impact of what we're doing for the environment and those kind of things? So that's the traditional way of doing a due diligence on people that come to us and want to work with us. When it comes to InsurTech, I strongly believe in reading. Reading is legalized theft. You can learn so much from other people. And this little booklet, it's really only a small booklet, provides a lot of wisdom how to look at entrepreneurial activities in times of technology. Many of you will be familiar with the name Peter Thiel. He founded PayPal, and he was the first commercial investor in Facebook. So he's got some track record there. There's a few more investments. And in this book, he summarized his view on how to look at tech startup companies. So what I've done is I've looked at this and what is really relevant for us when we look at InsurTech. And there are a number of different criteria to how we traditionally look at business. So the first criteria is what is called proprietary technology. So we want to see something in a business that is unique, that is difficult to copy, because that will provide you with a competitive advantage over time. That can be something entirely new that has never been before done, and I'll give you an example for that a little bit later, or it can radically improve something else. So Peter Thiel uses the factor 10. If something is 10 times better than whatever is existing at the moment, then you've got a sustainable competitive advantage. Or you can combine things that are there but haven't been combined like that before. Network effects, I think that's also very specific to the tech world. If you look at all the businesses that have become dominating in sectors, they all leverage a network effect. Scalability is a big buzzword, but I think it is important. You must be able to double and triple and quadruple your business without having to add significant resources to run this business. So the more digitalized the business, the better. And then last but not least, I think for an InsurTech, it's very important to create a good brand. And the brand must be a mixture of cool, in other words, challenging the insurance industry and appealing in a different way to the customers than the traditional insurance companies. But at the same time, it also has to have some substance, because you cannot just be cool, because at the end of the day, the consumer wants their claim to be paid when it hurts. So there has to be trust into that brand. And it's a very difficult balance to get this right between the cool brand with substance. But I think those 4 criteria are really important for the possibility of an InsurTech to be successful, for the possibility. Because the reality is it's bloody difficult for an InsurTech. Even on a global scale, we've seen very few InsurTechs that have reached the scale that they are economically viable. And the biggest challenge in this space is distribution. I think you see a lot of insurtechs around that have got fantastic products, very good idea, very good technology, but it all comes down to selling policies. And that's still the hard bit that we as the more traditional insurers have learned over 100 years, and we've got our distribution networks, and that's very difficult to crack for the insurtech business. So let me give you a practical example of 3 insurtechs that we are very closely involved with, that I'm personally closely involved with. They're all very different, and I'll take you through how they match up with these different criteria. They're all South African businesses, all with global ambitions, as every insurtech has got global ambitions. So they're Pineapple, Lumkani, and Investsure. If I go to Pineapple first, Pineapple is a little bit similar to Laka, so there are plenty of those ideas around. The first thing that you look at is user experience. So for Pineapple, you download an app, and then you can take a photo of whatever item you want to insure, and you fill out a few more criteria, and then it would be insured. That's the user experience. A lot of insurtechs at the moment, as I see it, focus on user experience. I think user experience is important, but as any insurer in the world is improving the user experience, it's not a sustainable advantage at all. You have to have more unique features in order to become a sustainable business. So what does Pineapple do differently? Well, they do collect premiums first, not after the event, but the premiums go into a wallet of the policy holders, and in addition to that, each user can create their own risk network. So it works pretty much like Facebook, where you connect with partners, with friends that you think are decent risks and that you want to share in the risk pool. And everyone's risk network is different. Like your Facebook friends will be different from other people's Facebook friends. And the uniqueness is that there's an algorithm that actually allocates claims according to your own risk network. So if I take you how it measures up against my 4 criteria, the proprietary technology is that unique algorithm that allocates the claims according to your risk network. And then Pineapple, similar to Laka, takes a fee. Whatever is left in the wallet of the individual gets paid back at the end of the year. The network effects is very clear on this one because you do create your own risk network. And what is important for a network, it must benefit the first user already. Yeah, a network that only works if you've got 1 million users on is not going to work. The network effects must come in straight away. Scalability, Pineapple is almost endlessly scalable without having to put on resources because the whole process from sign-on to claims handling is largely digital. There's still a lot of manual involvement on the claim side at the moment, but that is also being worked on, addressed. And the Pineapple brand has almost gone global without having launched global. They're getting a lot of attention for that brand. I think they've done a fantastic job in that respect. So this is Pineapple. I should have ticked these boxes earlier, sorry. Let's move on to the next one. Lumkani, very different business. This, what you see there, is a heat detection device. So it's installed in low-cost housing, in poor people's houses, and it discovers when there is a rapid increase in temperature in a very short period of time. It then sends out an alarm that should wake you up and make you evacuate your house. But what it also does, it connects with other such devices in your neighborhood and over quite a long distance. So people get a warning sign to evacuate their houses, and then in addition start organizing the firefighting. So in South Africa, it's a very particular problem that in the townships every year we've got fires raging through townships and destroying hundreds of shacks and killing people. So this is what this product is addressing. What we have done is we have combined it with an insurance product. Again, it's a low-income product, so it is very cheap, but it gives you enough money to rebuild a shack. So that is Lumkani, and again, the proprietary technology sits in that device, especially they produce it at very low cost. The network effects are also very clear because it all depends on the devices connecting with the other devices to be effective. The scalability is a little bit of a problem because in the markets that we're talking to, you still need personal contact. So scalability for this one, we're working on solutions. And you can arrange for payment solution, that's fine, but you still need to have someone installing the device in the house, and you need someone in the community that is trusted to actually allow you into the house and install the device. So that one is a little bit difficult for Lumkani. And then on branding again, I mean, in their relevant market, they've created a very credible brand and they're rolling that one out. Which brings me to the last one. Isn't that a nice photo? The idea for Investure was actually born out of a scandal that happened in Germany. I'm not sure whether you've followed that, but Volkswagen put a software into their diesel engines that was cheating the systems. It's a big thing in Germany. I mean, Volkswagen has suffered enormously from it, and so have many, many small investors that had some Volkswagen shares. To this date, there is no court judgment on anything like that, and I'm pretty sure that it'll take a few more years before we will see the first court judgments that Volkswagen did anything wrong. If I had bought some Volkswagen shares, I can't wait those 10 years to get my money back. So Investure has created a solution where you can insure your individual shareholdings against the case that management of a company is alleged to have pursued misconduct or have misled people. So we're not covering market risk, we are covering alleged fraud of executives of companies. Unfortunately, there are many cases like that, which is one of the reasons why the trust in the corporate world is probably at a record low level at the moment. So if we look at what Investure does, the product is absolutely unique. We've checked worldwide. We had to go through a new product approval process through all organs of our company, but we finally got approval. It will be very difficult to copy because the distribution channel is online trading platforms. So platforms where people can buy and sell shares. And once you're on that platform, it's very difficult to put a second product like that on. At the moment, we're only trading on one very small platform in South Africa, but we're selling very well. They've sold in a year over 5,000 policies already. And we're talking to pretty much every financial institution in South Africa to bring it onto their trading platforms. And we've already had the first conversations internationally as well. It was always the case we want to test this product on a small platform and then roll it out to bigger platforms and also internationally. So the network effects is clear because we plug into the networks of the online trading platforms. The scale, I mean, I heard that some people pay claims in a few minutes these days. Let me tell you the story. So we have had already claims events in the first year in South Africa. I think Investure must be one of the only businesses that actually alerts people to you can claim. So we are saying there is an event, management of the company has been alleged of fraud, and the share price has fallen. If you sell your share now, we will pay your claim. So we do that, we alert, we invite the claims effectively, what then happens, the person sells the share on the online trading platform and gets automatically reimbursed. So I think it could be a world record, 45 seconds for a claims payment. So this product is perfectly scalable because it's fully digital. The branding side is, I guess, a little bit of a weaker point there. I think we've got some more work to do on that one, but that will come also with rolling it out onto other platforms. And we've got the situation where we need to co-brand the product a little bit because the platform wants their brand, and then we want the brand for our product. So that is Investure, as I said, a world first product that we are very proud on. So coming back, do you want to invest into an InsurTech ecosystem, yes or no? That's a decision that you must take for your business individually. If you want to do that, if you want to partner with InsurTechs, which I think is a great opportunity, then you've got to formulate your own strategy, but there are some thoughts that you should keep in mind. I did say earlier that we've been very successful in our ratio of investments that were successful, and we didn't have too many failures. It depends on where you set your hurdle, but a lot of startups will fail, and I think you need to factor that into how you approach investing into InsurTechs. Most of them will not go for an IPO or will not find a trade buyer that pays a lot of money for it. What has been very important for us, because we start engaging with these InsurTechs from a very early stage on. In fact, Pineapple we have incubated. The guys didn't even know each other before. We put them into a group to work on something. Investure, it was a coffee meeting that I had, and out of that the whole business developed. So we partner at a very early stage of development, but we've always said we want to find professional co-investors for the businesses. The reason for that being is, as you probably heard from my presentation so far, it's easy to fall in love with these businesses. And you start to like the people, and then you're happy if they don't reach milestones to put additional money in and just hang in there. So that's why we've said we want professional co-investors that sometimes can take a much harsher view than us. And on all our InsurTech businesses, we have found professional co-investors. The second thing is, if you invest into a business, you must really believe this has got the credentials to become something significant. Because the tech business is different to more traditional entrepreneurial businesses, in as much as if you set up a traditional entrepreneurial business, you can grow it as the cash flow comes and that kind of thing. And typically our other entrepreneurial business become profitable after 18 months. InsurTech businesses will gobble up money for quite a while. So if you don't believe this one really has got the potential to become significant, then don't even bother about it. I also think you shouldn't invest in too many because it's a lot of work. You need to be very close. One of the biggest contributions that as insurers we can make to InsurTechs is to help them maneuver regulation. It's the biggest entry hurdle for business, for tech business into the insurance industry, and that's where we can help them a lot. So for all these insurtech businesses, we've found the most suitable form. Some are tech companies providing an IT solution, others are brokers, and there are many different ways how you can register that company and work with the regulation rather against it. Our philosophy is always to be completely transparent. We've spoken to the regulator in South Africa about all our businesses. They are fully aware what it is, what the product is, what the structures are. That would have been very difficult for the insurtechs to do themselves. That's a major contribution that we can make, and that you can't do for 100. Yeah? We believe we can do 5 to 10. We are at 5 now, so if we come across additional good ones, we will do it, but we won't do too many. And then a small number of companies will radically outperform others. So we might have companies in there that fail. We might have companies that become a sustainable small business somewhere, although, as I said, that's difficult in the tech space. And then we will have some that have got really potential also for international rollout. And we hope we've backed the right horse and that at least one of them becomes really a big one. That's my suggestion for a way to look at insurtech businesses. Thank you very much.
Thank you, Akeem. And now we take a quick coffee break and we'll convene back in this hall in 20 minutes. Thank you.
Check.
Welcome back, ladies and gentlemen, and thank you for your attendance. We hope you continue to benefit from these amazing ideas being discussed by our experts joining us today. We now move on to session number 4. Our next session is a panel discussion which highlights AI, artificial intelligence, changing insurance the way we know it. On our panel, please join me in welcoming onto the stage the General Manager of Bahrain National Life Assurance Company, Ms. Inas Asiri. Also joining us on this panel is the co-founder and CEO of Wealthy Therapeutics, Mr. Abhishek Shah. And the CEO of InfiniteWare and AI researcher, Mr. Amin Taja.
All right. Perfect. Thank you, everyone, for joining. And hopefully this will be an informative discussion. My name is Abhishek, and I'll be moderating this discussion. And the intent is to talk about things that, are a lot of buzzwords, but, bringing it back down to reality, what actually happens and what doesn't.
Test.
All right. So we're in test mode. And we have 2 amazing people here with us. We have Amin, who comes from the AI world. He lives, breathes it, and works across domains, including insurance. And then we have Inas, who looks at models where you can actually implement it, and hopefully in the insurance world. And this should be an interesting discussion. I'm going to start up, by asking a very quick question, which is that there's a lot of names flying around, a lot of implementation strategies, a lot of solutions out there. But at the core, it starts with data. So what do you see is coming up in the world of data, where data is being used to then create solutions on top of that? Anything specific that you'd like to add on how data is being mined, or how data is being used or developed, or so that it can then be used to build models on top, which can be used in the insurance world?
All right. Thank you so much for having me in here. Such a pleasure. I think on the data aspect, there's a lot of fronts that people can go in. If you're an individual, if you're a business, big data is a very common theme that we keep hearing, right? So the trick is you have multiple channels in order to get data from your customers, be it social media, be it videos, be it their sentiment online, wherever possible. And the magic is all of this really adds up and builds a lot of value for you as a business. You can do a lot of prediction. You can do a lot of really strategic thinking in the short term or even the long term. And as somebody who really supplies AI solutions to a lot of businesses, I think the number one issue that I see, the common theme is there isn't a lot of understanding illiteracy when it comes to data. So you go to companies and businesses and they want to have the state-of-the-art AI solutions like predictions, they want to have automation, but in the end of the day, whenever they don't have data, it becomes very difficult. So for me as a business, what I do is I have multiple layers or multiple, let's say, packages in order that I really provide to businesses. And the core package is data infrastructure. So providing this whole big data infrastructure that allows them to store their data the right way and to really utilize what AI has to offer. But yeah, to summarize it, I would say the common theme is understanding the value of data and really doing all those steps in order to provide the right infrastructure to get it. This is the main meat. If you're a business person and you're here and you want to get one of those AI solutions, the right thing is to have the proper AI infrastructure.
Got it. And maybe that same question to you is on the data builds a digital ecosystem on top, and then that data ecosystem then allows more data. Would love to get a sense on how you're thinking about using that in any form for the industry.
Yeah, just building on what Amin had mentioned just now, the availability of such rich data for us as insurers, it changes the game completely, because if you look at the time which is pre the availability of such data to us, what happens is that traditionally insurers would insure a risk and then just wait for that risk to happen, like a claim to arise, right? And then you would cover it because this is a promise that we sell. So now with the big data and having all the technology and the facilities to manage that, we are in a position to actually go out there and proactively use that data to prevent these events from happening, which helps us in our excuse me, which helps us in our claims management process. So you're not only managing the claim when it happens, you're actually trying to prevent it. So, which is a very big thing now in insurance, in all lines of business, but specifically I come from the life and health background, so it's even more relevant to us. You know, we always believe that prevention is much better than waiting for the condition or the death to happen and then pay claims after that. The other point that I could think of as well is that when you talk about applying for an insurance policy, whatever that is, obviously there must be a set of data as well that's involved. Now, we historically relied on the data that is provided by the applicant, and you just have to take it and, you know, base your terms and conditions on that. But again, with the availability of all this data out there and being able to manage it in an efficient way, now you can proactively go out there, get the data, you know, with all the sources, again, relevant to life and health. You know, when you're talking about all the iWatches available now and the Fitbits and, you know, the health-related applications on mobiles and all of that. So now you can actually use this data to refine your offerings to your clients.
Fantastic. You know, maybe a follow-up question to that is that how does an insurance company ingest such data? And what does it mean in terms of the organization and the stakeholders? Because traditionally, the data streams were looked at historically. You had underwriters trained in actuarial models that actually could use this data. Now you have new data streams which not only have never been seen before, never have been trained before, but you also have these same data streams being looked at by individuals which don't, and the same rules of underwriting don't apply, where you don't have historical data to then predict. What does this mean for an insurer as they embark on this journey of embracing these new data streams and doing something with it?
Okay, I think I always like to say that I would start my answer by saying that a lot of people think that AI and all these advancements in technologies are one day going to replace all the human underwriters at some point. That may be a threat, but for me the way I look at it is that whatever we have now, it's facilitating the accuracy and the efficiency of our operations. So the impact on that, just to answer your question now, the impact on that on our underwriters and underwriting processes is that absolutely, the way I look at it, it's absolutely positive. Now, the two buzzing words that I'm going to use is that everything is going to be much more innovative and much more efficient. In terms of innovation now and also increasing your efficiency, for instance, I'll quote an example on life insurance again, right? So historically, or like a typical application would be that an application form would be filled up and then like health conditions are declared, your height, your weight, your age, and all of that. So now there is a move towards using all of that into and using facilities like, for instance, the facial recognition applications. And some companies, the bigger companies now are moving into that space, and they're just using a picture. So like you literally just send a selfie, and then like, you know, they would use that to determine your age, your gender, to determine your smoking habits as well, like smoker, non-smoker. Underwriting happens based on that, and your body mass index as well. So all the basic underwriting can be done using all this technology, and like, you know, if it's a very straightforward case, then the underwriting is done, the policy, the rate is also determined, and the policy is issued. So you have eliminated a lot of administrative steps there, and enhanced the customer experience quite drastically. So this is one way of looking at it. Another example that I could think of also on the health side now, because health is more popular in this part of the world than life, is that using the virtual employees, right? So automating the claims process, this is at a later stage now. So virtual employees, or like they call them Dr. Someone, so they make it like, you know, more real. Yeah. And then, the conversation would happen there. So there's a lot of AI, there's the chatbots, also incorporated into that, the cognitive automation as well, and all of that. And then you eliminate a lot of the admin also, and the inaccurate answers that could go out, and it would answer a lot of the basic questions that you would, as an insurance company, we would answer on the common coughs and flus, and where should I go, and what is this covered within my policy, or is it not? So there is a move towards that as well. It enhances the customer experience. It cuts down the turnaround time, the time we take to get back to our clients. And also it increases accuracy because there are a lot of algorithms that are run at the background and they are taking care of it. So there is no way for human error in that instance.
I honestly, if I might add for a second, we really underestimate what AI is capable of. As a technical person, when you get to see those stats, you get shocked big time. For example, image recognition, which is a pretty complicated deal. AI systems can now get that with accuracy of 99.7, like digit recognition or even facial recognition. And so where I beg to differ with the lady here is in terms of underwriting, which is a very subjective aspect, to be quite honest, where you go and you assess the deal. I think AI, with a lot of data, can really be the best partner that you can have in doing all of that. So what I'm trying to say, if you really see the corporate world and insurance, banking, they're no different. And so there's a lot of common theme towards repetitive jobs. Those things where automation is going to definitely eliminate. There's no question about it. But on the aspect where you have to get your subjective sense into the whole deal, like checking if this is a fraud case or if this claim is really worth it, or even dynamic pricing, as you mentioned at the beginning. With a lot of data, what you're basically doing, you're somehow teaching your kid, in this case, think about it like as if the system was your kid. By parenting, you're giving them the intuition in order to go and do things the way you've done it across the years. So what I'm trying to say here, under the state, AI should not be really understood. As a technical person, it's really doing some magical work on the subjects that we, for a very long time, thought that it was going to be very difficult to get our hands on.
Fantastic. So maybe a follow-up question to that is, there's so much out there, there's so many applications, and there is an expectation versus reality when it comes to what an insurer can do when they begin, depending upon the data sets that they have, and the capabilities that they internally have versus they may externally need to get in. So you work with other industries, and would love to understand, how do you guide, between you have insurtech players who actually offer solutions like this, as well as large insurers who are looking to build models or build products and solutions that actually go? What should an insurer internalize? What should an insurer start investing into before they can even get anywhere? What should an insurer say, hey, this is not something that will ever be my core competency, let me go out and find a partner who can work with me on this?
I think the number one question that you have to ask yourself is, what do I want to do exactly? And this is the confusion that a lot of people get into. They want to get into the wagon of AI. AI is cool, let's do that, let's do this and everything. But if you don't have a concrete question, something that you really want to tackle from the get-go, there's no point of even accumulating data. So, and the second part is, data comes in all shapes and formats, right? You have your Excel sheets, you have your ERP systems and everything. But most of the time, we have a saying in the computer science world, we call it garbage in, garbage out. And so to really get the best benefit of AI in any situation, be it insurance or banking or whatever it is, you have to really make sure that your data is correct. There's no way around it. And then there are some common themes across corporates. For example, KYC, know your customer, sentiment analysis, the thing that we talked about earlier in the beginning. These are really trivial use cases that you can get your hands dirty in the beginning. For example, we have a product that goes with the name Abby. It's a chatbot that we deploy internally, and it really helps a lot those companies. Most of the time that we spend an hour, 8 hours work, is actually just looking for data, trying to get information from here to there. Mm-hmm. But with that perfect use case, where you have that super intelligent AI that exactly knows where to find the information, it makes it so seamless for you as an experience. And for me personally, as somebody who believes in the value of time, I think when you spare, a decent amount of hours in a specific day, you really have a lot of time to tackle different things that are really worth the time.
Yeah, makes sense.
I think I would like to add a couple of points on what Amin had said from a business point of view. the step that we have to always get back to is that we should always be very careful of not getting involved in the hype of anything. Like you said, it's just like a big thing and everybody talks about it. And some companies feel the pressure that we have to be a part of that because everybody else is doing it. So, and then after investment and getting there and being there, and then you would think, did I really need it, or what did I do, or what am I going to do with all of this
Blockchain
now?
is an example of that. It has a very notorious reputation.
Right, and the other thing is that once a company decides or feels that they must be in that space or do something with that, then it's definitely something that should not be held or left at an IT level at that company. It's actually a very senior thing that should go up all the way to executive management as well as the board sometimes. Now everybody's talking about having a digital strategy in place. It's not just like, someone thinking that I need to do something or develop that and then just go about it, because it's a serious investment that if you are into it, then obviously you have to invest in it and then make sure that it's a sustainable plan that, over a medium to long term.
Got it. No, this is very insightful. And then, once you have or you start building these capabilities as an insurer, when you put the ecosystem together, you actually start seeing better input data, alternative data streams, strong AI models being put in place, and as a result, incredible use cases. And then, what I would love to maybe chat with you on is, what are some of your top either use cases that you're seeing in action, use cases that are work in progress, or even predictions across different parts of the value chain, if you will? And maybe I'll start with you on, are there any use cases that you see for micro segments, for specific customer types, where you understand that customer and then build insurance products and solutions, or showcase insurance products and solutions specifically for that customer? Do you see anything of that coming in the next 1 to 3 years?
Absolutely. I think we started seeing it already, and it's just going to go, there will be more emphasis on that going forward. Now that we're able to collect relevant information on customers, and by that, I don't only mean what their needs are, but you're also talking about preferences, you're also talking about financial abilities as well. Now you are in a better position to develop products that are more meaningful to them. So not because I think it's fancy and it's going to just sell, but now it's working the other way around. It's always worked the other way around as well, but the AI and the availability of data now makes it even more doable in a better way. So now we start by looking at the needs, at the preferences, at the customer profile, but also, can they afford it, can they not? Sometimes insurance is expensive for large segments of the society, and it's not seen as a necessity, and that's why a lot of people run without insurance. So if we can dive deep into that and see, okay, maybe this person does not require this entire coverage, only this. And by focusing on developing something around it, the premium could come down from whatever I was offering it all these years to, I don't know, maybe 30%. And now you're making it affordable to this class of the society. And you're offering, you're including more and more people in the insurance industry, basically, and you're bringing them on. So it helps when you understand your customers and you have the tools to actually get to that.
And maybe the question to you would, how do you make that happen?
Before getting into that, some of the most amazing use cases in the way that I've seen lately is KYC. I'm really excited about how KYC is working. For the very long time, trust has been a very huge deal for us in financial institutions, be it insurance or banking. And so there's been this sort of explosion that happened in the last couple of years where people are becoming so generative when it comes to generating data, right? So you have your Instagram, your social media like Twitter and Facebook, and you're just being so verbose. You're giving a lot of people so much information, which could be bad on the topic of privacy again. But at the same time, as a business, you can really benefit because for a very long time, I'll give you an example. Like in banking, KYC, it's a horrible journey, to be quite honest, and you probably know this. You have a lot of people trying to investigate and trying to understand if their client is not doing anything shady on the side. But if you have that amount of work, that amount of data just scattering the web, just waiting for you to use it, this is beautiful. And the other aspect is that I'm really excited about is open banking. You know, open banking, again, just like blockchain, some people have different views on it, but for me, the ability for banks to open up for consumers, you know, for developers to utilize and add really solid use cases has been a fantasy of mine, honestly, where you can see the full track record of your customers. So you no longer have to do those shady things on the side where it's like, hey, this guy really playing it well, he doesn't have any shady things on the side. When you have the full track record of your bank account or customer, you can do a lot of better judgment when it comes to those things. Now, to make that happen again, coming back to your question, I'm going to have to reiterate it multiple times. Data comes first. Don't ever think that you can do anything in AI or machine learning to be more exact without getting your hands on data. And again, it has to be really good quality data. You know, if you're coming from the banking world where I come from, data doesn't have that amount of quality, to be quite honest, probably in my experience. And so people would just, like if they're working in a data entry job, they will just shove whatever they have in the keyword and that's it. But in order to have the best value of those prediction machines, those prediction models that you have, you really have to go and be so rigorous when it comes to, you know, validating the data. And then the thing that you probably don't know about if you don't come from the AI world is that the algorithms are already there. There's nothing fancy about it. It's just the most difficult part for you as a business is to take all of this data and then train it according to the questions that you want. So remember in the beginning where we said the number one thing that you have to do apart from data is knowing what you want in the beginning. Are you trying to find if this claim is a fraud or this is, are you trying to find a regression for the pricing that you have? So having clear intention in the beginning is the key deal. You can't just go around like acquiring data and doing things in AI without having a solid...
No, and which brings me to probably my next question, which is one very well talked about use case is building in dynamic pricing models. Exactly. And that is something that is worldwide is being utilized in a very efficient way, either to increase coverage to people who don't have it today, or to increase the amount of coverage, or to increase specific use cases of coverage, for example, chronic disease cover. And, you know, as an insurer, I would be curious to understand, or, you know, where do you see dynamic pricing leading to with respect to products and solutions for customers in the insurance industry?
Dynamic pricing is going to be the only future for insurance, specifically on with health insurance. Because you're talking about human beings now, right? And you're talking about changing health conditions and life expectancies and all of that. So yes, historically, it's like the pricing, although it evolved over time and it started much worse than where we are today. And we have added a lot of responses to a lot of variables as we learned from experiences, I think if we go back all the way back to when it started. I think the dynamic thing, which had started again, but you know, I think this has to be the future, and everything else will fall aside by then. It will be interactive as well. So it's very dynamic. So now it's like you could actually think that someone from this gender, this age bracket, you could actually think that the premium could range between so and so. Going forward, I don't see that happening because now you're putting more and more underwriting factors, and this is what makes it dynamic, and it could go either way, upwards or downwards. Like you get credit for it, not always thinking about extra mortalities or loadings necessarily. So the more information, the good information, not garbage one, okay? So the more information you feed into your underwriting, obviously that is going to help the healthy ones to come on board because you will be able to incentivize them then. And then the not so healthy ones, which maybe are struggling today to get cover to start with, and they're, you know, by some definitions, they're not insurable at all, you could still be able to devise something specifically for them to cover, you know, stuff with different terms, for example, different prices, or find different ways of covering things with, I don't know, certain healthcare providers, for example. So as I said, it works a lot with, it all starts from the prevention and then goes on to, okay, it happened now, what can I do with it? How can I manage it? So the managed care comes into the picture. And then those who I'm excluding today because of their conditions or their ages or whatever, the more information I have, my underwriting is now dynamic, and then I can include them.
Believe it or not, the challenge is not really technical after all. Even though I'm a technical person, I would like to think that the challenge is technical. It's not technical. It's all about data sovereignty. For example, in the US, where you have people who are really open when it comes to sharing their data, there's this thing that we call APIs, or basically integration. So we have your insurance company integrating directly with the health provider in this case, and there's none when it comes to the paperwork just going back and forth, right? Everything is just dynamic and that's it. So the challenge is not technical. It's just about having those entities really coordinate and you know, get a business model that work for the best of those you know, entities all together. And the data is just there. It has to flow from the right people to the right people. It's not about, you know, doing the work manually just like before. Every company has its own empire now. It's just about integration. This is why, coming back to open banking, I'm really excited about what open banking is all about, because for the very long time, banking, or banks in this case, have been this sort of black box that nobody really interacts with unless you're coming from the industry.
Right. No, and maybe the preamble to that is risk prediction, because dynamic pricing works very effectively when you have a baseline and then you work backwards or forwards from that. But how do you even get to that baseline? And a lot of insurtech and a lot of insurers are now thinking through what are the solutions that we can offer that allow us to be able to understand baseline data better, that allow us to predict risk better, to allow us to predict a future event better. And maybe again back to the industry expert in the room, what would be the use cases that you see where AI or technology, which is encompassing AI, starts playing a role on the prediction or, you know, the risk stratification side of things?
You will be able to successfully predict when you have sufficient information and over a period of time, and it's real-time information. So if I take it again and relate it to health, life and health, right? So in the example that I mentioned with all the Fitbits and the Apple Watches and all of that, when you are tracing somebody's lifestyle on daily basis, so you are looking at their average calories burnt a day, their blood pressure, for example, their heartbeats, you know, so you would get an idea now, how are they throughout the day over a period of time. So being or having access to this kind of data, this is what gives you the ability to make the right predictions, and whether it's a prevention or whether it's you want to encourage something to go on for a while. The same thing if, although I don't work in motor, but this is also an obvious example, like everybody talks about having those devices which trace your driving behavior. So that also gives them access to, data collection, which is very accurate over a period of time, and it's real-time data as well coming in. So it gives you a better idea, a very clear picture of somebody's driving behavior, and that would now help you predict, the rate of accidents or the possibility of an accident happening, or if an accident happened, what do you think, how bad could it be, or whatever that is. So in my opinion, if if we're talking about prediction and whether we want to stop it or minimize it or whatever, this is the kind of data or this is the kind of sources that we could rely on in order to make that happen.
Got it.
I think the takeaway here is that, there's a lot of sources when it comes to getting data. It's not like before. And the magic, the main need for you as a business developer, somebody who's really trying to take advantage of that, is to think about really solid use cases that can take advantage of those sources. For example, as Inas mentioned, I love Fitbit. I'm a huge endorser to Fitbit, even though I don't get any money for that. But the fact that I carry my Fitbit all the time really generates a lot of data that is on the cloud.
Right.
And for you as a business, just like insurance, it's so easy for you to write a program that interacts with my data, and I'll be more than happy to actually share my data with you if that is going to add to the experience that I get from my insurance company. And so what I'm trying to say here, the use cases are seriously unlimited. If you have a creative mind, it's seriously unlimited because the data is there and the technology really facilitates the whole thing. It's unlike before. It's not like that you have to do a lot of mundane work getting the data. Now it's just a matter of accessing that data with the right company, and just magical.
And maybe if we had to bring that magic to reality, there are specific products and solutions or entirely new business models that are now being created where we're intersecting insurance with real-time big data, right? So let's take an example of a real-time flight insurance payouts based on delays, where now you have products and solutions both underwritten by a reinsurer as well as then having an insurer backing it, where you have an automatic payout the minute a flight gets insured or delayed based on worldwide flight data. So there are situations where there are new products and solutions like the ones we've been speaking about, new features, new subsets, but then there are situations where an entirely new business model is emerging on the back of that. And then maybe
there's one that I would like to add if you can allow me for a second. Now, blockchain, again, I mean, you might have a lot of love or hate for blockchain, but there are some really genuine use cases that you can build on top of the blockchain. For example, there's a project in the US where you as a user can finally really leverage and monetize from your medical data. When you save your data on the blockchain, let's not get technical, but you can really provide your data for an incentive to those insurance companies so they can really train their AI systems after all. So think about it in this way. If you have, let's say, 1 million records of your customers, you might want to really expand the circle and get more data. But if you want to get data, you can even get it from the customers themselves if they have the data on the blockchain. If you can't get it from their companies or their medical institutions. So what I'm trying to say, just seconding what you're saying, IoT, blockchain, and even AI, I'm fairly biased toward AI in this case, but the amount of new business models is just crazy. You can do things that are relevant to B2B, B2C. I think it's beautiful. We're living in an amazing era, honestly.
And maybe a health example is where blockchain with AI is being used with genetic data is actually being used to do a automatic payout for gestational diabetes the minute it happens, because it's linked back to the EMR system, and when the event has happened, you have the data to know that it's genuine, and then the user doesn't have to do anything, the money hits the bank account. So these are examples where we would love to understand whether you see other business models completely being reimagined on the back of this intersection of new data, new AI models, and InsurTech and insurance all coming together in the next 1 to 3 years.
You want to add? Like if I had to really wrap it up, I'd say that, business is becoming really difficult, maybe for the giants now, because everything is accessible. For me as an individual who's working from home, it's pretty easy to get access to data, to build state-of-the-art AI models, AI solutions, and really build on top of the best solutions that are open source in the first place. So it's not like that I have to create the magic inside out, reinvent the wheel. It's just a matter of just getting the right tool and build on top of it. And if you really want to see the startup scene in Bahrain, that's pretty much the deal. So people get open source solutions and they somehow tweak it and tailor it to really fit a need. The technology is there. Data is a challenge, how to really get it. I think now with the data protection thing that I'm really excited about, at least you now as a user, you get to have some rights when it comes to sharing the amount of data that you have. Businesses will no longer have the ability to go and abuse what they know about you. They will have to get your consent. So all in all, I think it's amazing times, honestly.
And maybe that point is the last point to wrap up and open up for questions, which is how do you balance data privacy as an individual with the fact that as a business, unless you have the data, none of these new solutions can ever come to the user to begin with?
I was waiting for you to bring that up, actually, because it's one of the topics that whoever knows me knows that I'm paranoid about, like data leakage and privacy and all of that. So I think that is the one or the major intrinsic risk that I would attach to AI. We said all the positive things about big data and what to do with it and how to collect it and how can we use it for our advantage. But we always have to remember that that risk is running in parallel. And at the moment, I personally, I'm not sure that we can actually eliminate that risk altogether, because it is a risk there that needs to be managed. And obviously, when you have the right resources to manage it, then you're in safe hands. But that is not always the case. So the thing is that, for instance, with the Fitbits, or the car, the sensors or whatever, you are getting a lot of data, much more than you need as an insurer. For me, as an insurer now, I need it for the purpose of analyzing lifestyle or behavior. But I'm getting, along with it, additional information that I really don't need, right? So that's invading someone's privacy. And that is where not only my problem, but I think, everybody in the AI space cannot really turn a blind eye to. So since he has solutions, maybe he would like to add something to that.
Biased to certain technologies, but I wholeheartedly agree with Anas. The privacy has always been a challenge, and if you think that you really retain your privacy, then definitely you're wrong. I mean, you're probably familiar with the attacks that have happened against Facebook, right? Now, this is a really hard-hitting lesson that, security is an important deal that we cannot neglect anymore. And for me personally, as long as we have the human factor involved, we will always be in that goose chase, where we're trying to get the best of our security. And this is what really excites me about blockchain. Again, hate it or love it, depending on how your views are. But the blockchain technology really helps out. Can I borrow yours? Sorry. Not the best days for me here. But what I'm trying to say, the technology, the blockchain technology really allows you technical-wise to go and save your data, to really have full ownership of their data. So this is why I'm super excited about blockchain, because for the first time, my fate, my data fate is not in the hands of another company, I wholeheartedly, have the ownership over my data, which again raises a lot of challenges for me, because think about it in this way. If you lose your ATM card now, what you can do is go to the bank, get a new one if you present your IDs, and you're good to go, right? In the blockchain space, if you lose your ID, you're done. You're good. You're good. So there's a lot of technical challenges to it, but for me, the perks are amazing. You no longer have to go and trust a middleman, to facilitate your operations. You can really take 100% ownership of your data.
No, got it. And with that, we'd love to bring this panel to a close and open it up for questions. The conclusion here is AI is here to stay, blockchain is here to stay, and AI-enabled solutions are coming up. Now, those that don't come on board will eventually get left out, but at the end of the day, there is more in it for your end customer, and that's what we're all in it for. So thank you so much for your time. Do we have time for any questions? Are there any questions? No? Yeah.
Devices such as Fitbit or the device, you start thinking that the people who own these devices are coming from a specific socioeconomic background, and I think that creates some kind of bias in our results for the AI agent or any kind of solution. So how can you counter that, especially that we know in this region, maybe not a lot of people really appreciate such devices or even purchase them because of the privacy issues. So how can you create a fair AI or a fair solution that can bring you a good prediction when your data sources is maybe not that diverse, I would say, because probably the people who own a Fitbit or own that expensive device inside their car are coming from a specific background. So how can we diversify our data sources, especially in this region, in Bahrain or in the MENA regions generally? So that's the question. Anyone, honestly, I'm very interested to know how can you counter such difficulty. Because in the US or in the UK or in Europe, maybe you can find more people using data collection devices and they wouldn't mind sharing it. However, when you come to a more Arab region, still people عندهم تحفظات على الموضوع, or people can't afford, or maybe it's not very common. So how can I build a good solution when my data source is not that diverse? It will eventually create a bias result, and of course we don't need that when we are doing our testing phase. So what do you think?
Maybe I can answer this as an insurtech provider, not necessarily as an insurance player. The bias doesn't necessarily lie in the system if you're able to understand that there's a bias, and then for that demographic, these AI models work. But for this demographic, it doesn't, and then you build something else for that. The only correlation that I can come up with right off the top of my head is something that Ant Financial did in China, where there were only 25% of people that were banked, and the rest of the Chinese population was unbanked. And but they all had mobile phones. So what Ant Financial did was they created what they call a Sesame Score, where they took social data, they took behavioral data, and they took whatever transactional data they could find of that user, and then made a score out of it. And as a result of which today it covers 65 to 70% of the entire Chinese population on the back of models that never existed before. And now insurers are building risk prediction models and entire solutions that are catered to customers on the back of that Sesame Score. So sometimes the answer lies in an innovation. You start from the baseline, then you build from there for a population that doesn't have this history, or a population that doesn't have access to connected data. But you have to start from somewhere, and that somewhere could be the smartphone, and then you build it from there.
I think I'd like to add exactly what you said, Abhishek, that there will always be a baseline which is based on general data that is out there. The devices that we had mentioned as an example, it's going the extra step for individual incentives, if you like. So with the entire database or the big data that's available out there, you would always have a baseline that as of today, if I don't use any of those tracking devices, I still have something that I believe it's reasonable and fair for all the entire population to generalize it across them. However, we're trying to sell or encourage people to look after themselves from a health point of view, to look after themselves, the lifestyle, for example, the health conditions and all of that, because we're interested in prevention, and also to incentivize them to do that with the idea that we're helping the society to become a better, in terms of health-wise, a healthier population, but also with the idea that we want to reduce the claims cost, which will help us eventually reduce our rating or premiums to start with. But that is the next step. However, the first step is always, it's fair, it's general, there's always a baseline for all.
Thank you. I think from a technical perspective, model bias has always been an issue. You probably know that. And if you work in a company, you only have access to your data, model bias will always be the case. And think about it, big companies like Amazon and Microsoft still suffer from the same problem, right? Remember the face recognition thing that happened, and you don't really want to blame Amazon, but this is the sort of data that they have access to, right? So I think bias will be an ongoing thing until we come up with really maybe machine learning techniques that are really solid in terms of the status quo currently. The status quo in machine learning is that you have to get a lot of access to data, and then given the way you categorize this data, your model will be efficient against that. And so there are some really cool tricks like unsupervised learning, really cool tricks, different techniques that can deal with data from a different angle, and that might really eliminate bias. I think, or at least I'd love to think. And maybe expanding your data set, which is not an easy thing to do, but to say definitely it is, it could be a different option. Somehow expanding the circle of your data set. But yeah, I think time will tell. Speaking on the Fitbit thing, Bart, I think tackling a different market share, for example, Fitbit has a specific price range, right? But you've got alternatives that are lower in terms of price, but you don't get all those fancy perks that come with the Fitbit, right? In terms of data access and APIs and all of those things. But if you can somehow manage to do a conditioning pipeline for the data that comes from those external vendors, apart from Fitbit, and then to add them in your data set, that would be really a cool project to work on.
Cool. Thank you so much. With that, we'd like to end the panel. All the speakers are available for further discussion in any of the breaks. Thank you so much for your time.
Thank you very much.
Thanks to our distinguished panelists, Inas, Amin, and Abhishek, for your valuable insights and takeaways on the changing landscapes of insurance and the application of AI. We now move on to our next session, entitled AI's Role on Risk in Health and Life Insurance. This will be highlighted by the co-founder and CEO of Wealthy Therapeutics, Mr. Abhishek Shah.
Okay, fantastic. Good to be on stage for the first time today. This is a topic closer to my heart on how we can actually implement solutions which generate from AI in specific use cases that actually help the end customer. And that's what we're all in it for, right? So Wealthy is a company that was formed 3 years ago with that specific mandate, that how do we help reduce risk, and how do we, through that reduction of risk, really increase the quality of offerings, the quality of life for our members. And that journey began with a specific premise that risk is changing, insurance is changing, and the catalyst in all of this is big data. The catalyst in all of this is mining that data, machine learning and predictive models, and AI, to sum it up, where at the end of the day, the man was the actor in insurance or risk 1.0. And that man-machine collaboration is something that is now come of age. And we're working very closely with the insurance industry to build this, so especially reinsurers who are coming on board to see that insurance shift and the world shift into completely new, unimaginable sort of eras. And in that process, enable a very specific question to be answered and a very specific journey to be traversed. How do you move from just pricing risk to influencing risk? And this is an important piece of that journey, right? And how do you do that again and again and again? Because the new landscape is changing. Digital insurance models are completely reimagining product innovation. We all went through this journey. If this was a decade back or even as little as 5 years ago, it was all about tech enablement. How do you make that you take your existing products and then innovate with incremental features? How do you make sure you already have something, you don't want to reinvent the wheel, so you add two or three things more that comes with tech, and voila, you have a new product, or you have a product plus plus. Then that journey is sort of moved into, for some insurers, into an ecosystem integration, where this new data streams come in. There is a need discovery that is extremely dynamic in nature, where you don't rely on consumer research only, or on going out and seeing what are the new cool products and solutions, but you actually start discovering what the consumer wants by tapping into the data streams, what you have and what is already out there. And then you tailor products specifically for that demand, for that customer. It could be a customer of 1, it could be a customer of 1 million. But at the end of the day, it's tailored. And then that dynamic pricing kicks in. And then where the industry is moving towards is ecosystem aggregation, where completely personalized services are integrated together, and the dynamic features of your products are actually being adapted real time with the customer's needs, their risks, their behaviors. Because honestly, and the co-panelists in the previous discussion spoke about it, there are already incredible data streams out there. There are already incredible technologies out there. There is computing systems, there's precision medicine as far as genetic profiling or any other data is concerned as far as healthcare. There are distributed ledgers in the entire blockchain space. There are sensors, there are connected devices. All of these systems are there. There are no discoveries that are required. We already have them. It is just about reprioritizing how the combinations are put together, and you take existing and operational technologies and you then have something spectacular in return. Because at the end of the day, when you collect data with better front ends for that customer and you get alternative and push that into the larger data set, you actually have new AI models which are already ready and then can mine this data for propensity to buy, for risk scores which are dynamic and personalized, propensity to claim, propensity to lapse, and these are the things that are actually required. And when you take all of that and then you build on top, you actually can build fantastic AI-enabled solutions that can contextualization and make sure microsegments of populations are actually taken care of. You can make sure that alternative data, digital health data can result in automated underwriting, predictive underwriting, extremely dynamic processes for risk assessment, dynamic pricing, making sure that identification, prediction, and management for claims, which is a huge aspect, is done. And then actually to complete the customer experience, you have the ability to automate that claim and make sure that there is a payout in real time. If you just take that and you zoom in on health insurance or health and wellness, even if it's from a life insurance perspective, which is the area of expertise that I come from, then there is an actually different value proposition, because you're moving from what we used to call a linear value chain to a on-demand, personalized network where everything is around that user, whether the user or your member is a customer who's living a healthy life, or that user or customer becomes a patient and is on the sick side of things. Making sure that every need of that customer, be it a need to get healthier or a need for a transaction around the healthcare paradigm, whether it's a consult, it's a diagnostic test, it's taking your medicine or ordering your medicine, or it is around services, around tracking your health, it is around personalized lifestyle and management, actionable insights, you name it. This is actually happening, and these ecosystems are now merged with insurance solutions out there to really create incredible products out there, because these digital solutions are actually doing this job well before insurance started doing it, which is bridging the customer needs and the customer experience gap, making sure healthcare is available on demand, making sure connected devices and personalized care is available at the touch of a button to each and every one of your customers, ensuring that treatment innovation happens across the paradigm, not just at the end stage, but also at the prevention side, building an environment that actually allows for all of this to happen. There is such a relationship that actually can be built on the back of all of these services, and then the minute you integrate them into larger insurance solutions, there's a lot out there, because you can create very innovative, tech-enabled risk management solutions across the entire value chain of healthcare. It starts from basic health and wellness, and it goes all the way to recovery and even palliative care. And in the middle sits something that we all know, the role of AI, imaging tech as far as diagnosis is concerned, making sure health management is taken care of, treatment is taken care of. In that health management, treatment, and diagnosis, there are hundreds of companies that are out there that are constantly mining the data and making sense of it. But then you're actually seeing all of this translate into real products and solutions, which you can see live in Asia and the Middle East. And you're seeing insurers partner with insurtech providers in this region to create some substantially amazing products and solutions. AIA has done this in Singapore. MetLife has done this in at least I know for a fact they've done it in Hong Kong. In Thailand, there's Bawan for Better Care, which was done with Muang Thai. We're doing it with Aviva in Singapore. But at the core, what you're seeing is an entirely new paradigm shift of insurtech working with insurers to create completely new solutions which leverage all of the things that you saw before you to create dynamic pricing solutions, to create contextualized, micro-segmented, targeted products and solutions, to create automated underwriting processes, automated payout processes, and really reimagine the customer experience in the process. If you take an example of Vitana, which is where a genetic testing company, a reinsurer, a health tech company came together to ensure that a customer who is planning a pregnancy can opt for a cover. It uses the blockchain at the back, ensures that it takes the data. In 30 seconds, you can buy your insurance, and then it connects back to the EMR, EHR, so that whenever, if ever, an event happens where you are diagnosed with gestational diabetes, it is a no-click cover. So without the customer having to even move a muscle, even to claim something, even to fill a form, or let alone even press a button, there's an automatic payout to that customer in seconds of an event actually being diagnosed and happening, because there's trust in the data. And obviously that trust is really important, and blockchain comes into consideration for that. But imagine these sort of solutions out there. It completely changes what we think about our traditional insurance solutions and builds a whole different kind of solution to bring to the table. Take an example of what Muang Thai did with Swiss Re in Thailand, where it's a dynamic pricing cover where for type 2 diabetes patients, as the HbA1c drops, the premium drops. Very simple and extremely effective. And what's happened is now premiums, which traditionally would have been, sitting at X, for 50% of the population go to X divided by 2 or X divided by 3, because you have the ability to do it. And only with that constant data stream are you able to make sure that the customers who are safer get a better insurance. And then those safer customers end up being stickier customers, because they can only maintain that pricing when they stay with you, the insurer that gave it in the first place, whether they have to restart if they go to another place. What we're seeing is that in markets like India or in emerging Asia, where there's a whole different problem, where you have to actually get the solution to work in low-cost markets, low-cost infrastructure, little or no data. Actually, there's a lot out there, because even in a market where insurance premiums aren't maybe $1,000 a year, but $100 a year, there's still an arbitrage that matters, because price sensitivity is there. So how do you work with member partners to reduce risk and to improve the entire paradigm shift? Because that opportunity is an incredible one. Actually moving from pricing risk to start influencing risk. And when you do that, there's another upside to this, because you're completely reimagining the relationship that you would have with your customer, and hopefully move it from it being a backup plan to actually being a health partner or a partner in their journey. And hopefully in that process, increase positive brand trust that would come as a function of it. Of course, my slides have pieced out. But the larger story just remains fundamentally the same. There is an incredible opportunity to do this at scale, and it requires the entire ecosystem to come together, insurtech solutions, insurtech providers, insurers, reinsurers, government systems where relevant, and of course the regulator, because that intent, that innovative mindset, and that ability to market is required. And then the last piece of the puzzle is, even if you do all of that, you need to ensure that you can influence risk. And then influencing risk is a very, very important, double dip, if you will. Hyper-personalization is key to that. Cultural adaptation is key to that, because no two customers are the same. And you cannot treat a customer as a population, you cannot price a customer at a population level. But most importantly, a one size does not fit all. And that will fail in Asia, that will fail in the Middle East. And as we recognize that, you have the ability to ensure you work with insurtech solutions that solve for that, because however well you price, influencing is a whole different ballgame. And then when you start looking to influence, you have to understand that there's more to it. So if you take the example of health and chronic diseases, which is where we operate, then ensuring that there is something that a user sees is not enough. You need to ensure clinically validated solutions at the back, constantly working towards ensuring that you understand what that person's condition is, and then hyper-prioritize that condition's metrics to move from A to B, while also maintaining a level of engagement and improving their quality of life and all the other metrics, and ensure that the ecosystem is covered. Insurers have their dashboards, doctors have their dashboards, virtual care is sort of taken care of remotely, there's designing happening at the back. But essentially, what you're fundamentally focusing on is how do you use AI, behavior, machine learning, and then build incredible customer experiences that actually engage, that actually reimagine the way in which your relationship with your customer should be. And ensure through all of that, you build experiences that your customer understands. So don't make them click 20 buttons and fill a form when they're used to voice, when they're used to chatting. Ensure that you build experiences where the customer knows exactly what's going right and wrong real time. Give them insights so that they're able to do a better job. Make sure that you ensure the content and the solutions are imagined in a way in which you're improving that customer's health literacy, that customer's skills to manage a chronic condition, and in the process, then start building those skills relevant to ensure the confidence goes up, risk goes down, engagement remains high, and overall, get a happier customer, healthier customer, get a customer who is more empowered, more confident to manage their condition, while at the same time, inversely, capture all the data that you need to be able to ensure that you can price that risk and reimagine that risk through a dynamic pricing model at every stage of the journey. Build the profiles that are necessary. So merge what is relevant from a functional domain of, say, health and wellness in this case, and then combine that with what's required from an InsurTech case, and then build really the solutions that matter. Because when you combine these forces, build user-centric design, focus on behavioral science, build sustainable solutions that actually for your users, you're able to solve for problems which even go beyond healthcare. So today we work with Novartis, with Abbott, with Roche Diabetes Care, where we're building this category of digital therapeutics, which are working with pharma, medical device companies, large hospital systems, large clinic systems, and also, of course, working with health insurers, life insurers, and completely reimagining how reinsurers are underwriting the risk, because that's really, really relevant. And hopefully, through that process, do this. Because today, the member populations that we are treating are seeing results. Those results matter because if you're able to reduce that risk via the metrics that traditionally you've been pricing risk on, then you can get to sustainable dynamic pricing that actually makes sense. And each and every one of these metrics have to trend in the right direction at a single user level, at a population level, and then only those users that actually do improve, only those members that improve get the benefits, and then you build stories around them to make sure that the model works, because you can get really, really happy customers and an extremely, extremely profitable book, and in the process, expand a new market. Hopefully, this should be the new age of insurance as we work towards building a new relationship with our customers. Thank you so much for your time.
Thank you, Abhishek, for your highlights on AI. It is now time for break number 2 for refreshments and prayer. We convene back in the hall at 12:15. Thank you very much. Check. Welcome back, ladies and gentlemen. We now move on to our next session, which focuses on data science and the impact of its role and operations on insurance. Highlighting these ideas is the Assistant Professor of the Department of Mathematics from the University of Bahrain, Dr. Sausan Hilal.
So, good afternoon. In this talk, we will shed light on the potentials of big data analytics for insurance industry and how big data is reshaping this important sector. So, let me start first with the traditional insurance, where the adopted business model mainly consists of two parts. On one side, we have the customer who takes policies based on the possibility of occurrence of some risk-related events, like, for example, car crash or something else. On the other side, we have the insurance company who offers a coverage based, of course, on cost assessment for the possible claims. This insurance, or the business model that adopted by traditional insurance, suffers from a list of deficiencies as listed here, and I will go through them quickly and then highlight how can big data at least solve some of these deficiencies. So, for example, there is no effective communication between the customer and insurance companies. And the reason for that, the insurance company mainly is a product-centric rather than customer-centric. Also, they adopt the traditional marketing strategy rather than the recent strategy based on the digital and automated marketing. In terms of risk assessment, then we can say the mathematical abstraction for risk assessment is the implemented approach rather than using real data analysis. I can say also that within the traditional insurance company, there is no actual attempt for reduction of risk. And the reason for saying this, because there is no action taken by insurance industry in order to detect possible causes of risk and hence mitigate that risk. In other words, we can say that insurance companies work within the reactive framework, not the proactive framework. As a result of this adoption, we can say within the traditional framework, then there is no reduction for the probability of risk, but only for the financial impact of risk once we have something bad happen. And finally, it's a service company with mainly individual-based work. Most of these deficiencies have been overcome due to the recent transformation taking place within the insurance industry as shown to the right. And before going through the potentials of big data, let's talk a little bit what factors contribute to this transformation within the insurance industry. We can at least pinpoint 4 factors. We'll go through them, and the focus will be for the last one, which is big data. So the first factor is changing in customer demand and expectation. So insurance companies should take into account that they are dealing with educated customers. And these customers are requiring the services provided by insurance companies to be personal and competitive. They also expect these services to be provided by the way they want and when they want, and also by the channel they choose. If we didn't take into account this, then insurance companies will face the risk to be left out comparing with the others. The other factor certainly advances in technology will improve the performance in the insurance industry and other sectors as well. The third factor, disruptive environment, existence of competitors not only within the insurance space, but even outside the insurance space, which introduce a new business model. And the last factor, which is the focus of the talk, that is the increase in data, or what we refer back to as big data. So let me start with a simple definition for what do we mean by big data, and then talk about the potentials of that data for the insurance industry. Big data is a terminology referred to massive collection of information that's constantly streaming from different resources and also comes in different format. So big data at least can be characterized by 3 properties: By volume, we are talking about a huge collection of data. By velocity, because it is real-time data. And finally, by the verity, because there are structured and unstructured data. Let me just pinpoint to something already mentioned in the previous panel discussion. Unfortunately, even up to that date, there is a kind of failure to extract full potential for big data for insurance industry, even it is an important factor. Now, before going through big data use cases in insurance, let me first raise a concern why big data is really important for insurance specifically. And the reason behind this interest is the nature of work for insurance. Insurance industry is mainly an information-based business with data-driven operations. Therefore, if we can use unstructured data, for example, text, video, and I augment that data with the historical structured data, then we can generate invaluable business opportunities. But of course, we need to keep in mind that we will get that insight, we will get these great opportunities if we have a proper analysis for the big data we have it. I would say it in a different way. The insurance companies need to exploit big data, of course, using advanced analytics in order to provide actionable insights. And to elaborate on this more, I will go through the 4 phases of insurance value chain, talking a little bit about product development, underwriting and risk management, claim processing and fraud detection, and finally ending with marketing and mention some examples for illustration. So for the first stage, that's product development. One notable advantage of big data use in insurance industry is what we refer to as customization. So by collecting details about the regular activities of the customer, for example, driving behavior, or using even the devices we have them in home, these data can be used by insurance company in order to provide an accurate risk profile, and then using that profile in order to provide personalized and usage-based services. We'll give in a while 2 examples to illustrate this point. One is related with car insurance and the other one is related with home insurance. But before doing so, let me proceed with the next stage, talking about risk management. Another important area where we can use the details and big data is providing better understanding for the concept of risk. Why this is important? Because the concept of risk is a basis. It's an entire foundation for the insurance risk. So think about using the details, relevant information we have there in order to enhance our understanding for that concept. Then definitely we can provide an accurate risk assessment. We can provide efficient policy premium. We can find like a balance between affordability and profitability. Affordability from the customer point of view and guarantee also the profitability from the insurance point of view. Third area, that's claim processing. Claim processing is an activity where outstanding services concerns load for both insurance company and the customer. If we are able to optimize this process, then we can ensure controlling the losses. We can also increasing satisfaction of our customer, enhancing their experience with the insurance company. And indeed, the claim processing is not a single-step process. Rather, it's a multi-step process where in each step, decisions need to be taken by the insurance company. This is exactly where big data and the details, relevant information prove to be useful. If we have details about, for example, the customer behavior, about the trends in insurance, we can use these details in order to optimize the claim processing. For example, we can provide accurate prediction for the claim likelihood. And once we have that likelihood, we can provide evidence-based evaluation for the damage we have. Another important area related with the claim processing, that's fraud detection or fraud prevention. It's acknowledged that fraud brings vast losses for insurance companies every year. And definitely, if we have big data to be used in order to prove this process, then that is a significant improvement. This is usually done by analyzing psychological and behavioral characteristics of the customers by the insurance company, and then matching these characteristics of the historical profile they have it for cases known to be fraudulent claims. and then give a trigger whether the new claim is considered to be a genuine one or it's a fraud case. The fourth area, which is the marketing. Insurance companies can use the details, demographic data, for example, the lifestyle, the behavior, the attitude, the preferences, interest, all these details about their customers, and then use that details in several areas. For example, they can use it to predict customer lifetime value. They can use it to facilitate acquisition for new customers, or even maintaining the current customer they have them, or prevent the customer churn. They can also use the details or the characteristics they have them about their customers in order to support what we call it customer segmentation, so dividing the customers into classes based on common characteristics. And then for each group, we can developing target cross-selling policies or offering specific, for example, recommendations and having a tailored marketing campaign. So all these areas can be used effectively with big data analytics. Let me just mention some examples here. One of them from Hollard, which is South African insurance firm. That company provides usage-based car insurance, and based on devices, telematics installed in the customer car in order to report the behavior of the driving, and using these data in order to analyze the behavior of the customer, and based on that, they will provide a specified price based on that customer behavior. So the insurance company provide actually two options: pay as you drive and pay how you drive. Along the same trend, we have another insurance company, which is UK home insurance company, Neos. They also provided usage-based insurance, but that is for home insurance. And they encourage their customers in order to invest in smart technology and using home sensors. Similar one, which is the American insurance company, Life Insurance, John Hancock. They used also like wearable devices in order to detect the healthy lifestyle. For all of them, they use data in order to analyze it, and based on that, they provide personalized prices. Well, I have a list of examples, but I think I need to skip them all because I want to talk a little bit about insurance industry in the MENA region. Let me start with a study by Swiss Re Institute, which mentioned that the insurance industry within the MENA region generally is young and underdeveloped. However, just yesterday, we heard from the executive director of the central bank in Bahrain about the landscape of insurance industry within the MENA region. And he mentioned clearly that we have significant opportunities within the region for development. And I do agree on this. MENA region, even it has underdeveloped insurance industry, but it is one of the attractive regions to adopt a transformation. There are certain factors behind that. For example, we have 70% social media adoption. We are talking about population of 380 million with average age of 26, so we are talking about young people, these people who are keen about adopting transformation. It's also among the highest mobile penetration rate in the world. So these factors mean there is a chance to adopt a transformation within the insurance industry and develop that sector. Notable examples and initiatives, both of them in United Arab Emirates, is one Aqid, which is mainly for car insurance, and there are other services, and the other one, Demogrants. And I guess the next speaker is co-founder for this insurance company or the initiative, so he can talk a little bit about it. So let me summarize what I have said in this slide. On one side, we said we have underdeveloped insurance industry in the MENA region. And on the other side, that we have also opportunities for development. So the next question, what is the way forward? For insurance industries, for insurance companies, we have them within the MENA region in order to adopt the transformation within the sector, to develop their operations. They need a comprehensive big data strategy, of course, coupled with a transformation for the technology. They need also to invest in development of a human. So there are certain factors need to be taken into account, certain strategy to be highlighted, which technology will be adopted and used, skills, capabilities, which partnership they will do it, because mainly these cases will be through the partnership, not individual work, customer engagement, and also thinking about ethics. I will mainly focus on the highlighted one, which is the skills capabilities, and I will mention example from Bahrain, given that we are presenting here. Just recently, University of Bahrain, which is the national university within the Kingdom of Bahrain, officially launched its master program in Big Data Science and Analytics, and that program in partnership with Liverpool John Moores University in the United Kingdom. This is really an important step to provide society with the skilled people to handle big data, because the existence of data itself is not wealth if I don't know how to handle it properly and analyze it. And this is an important step not only for insurance industry, but effectively for all sectors within the society. Let me return back now to the general view and ask generally for all in the insurance industry, not only within the MENA region, what comes next? On one side, according to Accenture Technology Vision for Insurance 2019, then insurance companies need to prepare themselves for what they refer to post-digital era by mastering certain technologies, for example, social, mobile, analytics, and cloud technology, what they abbreviated as a SPAC. Insurance companies also need to prepare themselves for a new set of technology like distributed ledger technology, artificial intelligence, and the others which are abbreviated as DARK. That's one side. The other side, we shouldn't forget also that insurance companies face the challenge of the 5G, where that result definitely with a vast increase in big data. So I would say the final message to be delivered for insurance companies in order to differentiate themselves from the competitors and also to create their market position, then they have to keep in mind that big data remains an important asset to be fully invested. If they take into account this and all the factors that need to invest big data, then that will be the result for the transformation. Thank you.
Thank you, Dr. Sousan, for outlining these key concepts for us. We now continue our program for today with another interesting case study entitled Digital Disruption Channels by the CEO and co-founder of Democrans. Please join me in welcoming onto the stage Michelle Grosso.
Thank you. It should work, I think. Hello, everyone. My name is Michele, and I'm the co-founder and CEO of Democrans. Democrans is an insurance technology startup that makes insurance accessible and affordable for those who need it most. Our mission is to enable insurers to access new underinsured and underserved customer segments. We're based in Dubai. We are present in 8 markets in the Middle East and North Africa region. And we just opened our first market in Southeast Asia in Cambodia. One of the markets in the region is in Bahrain. Do you hear me well? Yeah? So we're very happy to be here. We're here to talk about digital disruption channels and hopefully to bust also a few myths. So the first one being, when we talk about, I think that this one is not working. Next slide. When we talk, previous slide. When we talk about microinsurance, the people say Dubai is not the right place. There are no poor people in Dubai. This is not quite right. There are 2/3 of the population that gain less than $1,000 per month. And actually, we talked to a few of them. We've interviewed 1,200 low-income residents in the UAE. We asked them which insurance products they have, and 80 to 85% of them do not have any insurance product except the mandatory health that the sponsor or the employer is actually providing them. same like in Bahrain, which is often not enough and not efficient. And they told us too that, that they actually need insurance because their lifestyle and most importantly, the lifestyle of their family is enabled by their own salaries. So they need life insurance, they need medical insurance and savings insurance. And they're actually ready to pay for it. They're ready to pay 2 BD, approximately $5 per month for it. Next slide. And, previous slide. Okay, now it's working. So the way that we enable insurers to get access to new segments is by automating and digitizing the whole insurance value chain. So from marketing and sales, to policy administration, to the collection of the insurance premium, until claims management. We do so on the front end, so for customers to be able to buy, use, pay for, and claim for insurance just using their mobile phone or any digital device. But most importantly, as all the insurers in the room know, the hard work in insurance is to digitize the back end. So our platform works as a fully fledged policy administration system to be able to manage all those policies digitally and automatically. Insurers have been using our platform now to run their whole insurance business, mostly on the personal insurance and most recently on the SME insurance side, from a traditional insurance point of view. So, but then once they have, they get used to our platform, they realize that they can experiment new product line and new customer segments like microinsurance, because the additional cost to sell and to serve is almost zero. What we do, and I mean, I'm bringing a few examples later for you to see, but from marketing and sales perspective, our platform offers an omni-channel approach, so via any digital and mobile device with an individual segmentation. We support existing distribution channels of insurance. So we don't think that the digital and mobile will replace the traditional insurance and distribution channel. On the contrary, they will complement it. So we support agents and brokers, banks, and affinity channels. Our policy administration system supports straight-through processing, automated underwriting, and ensures they can automatically issue and file a policy and claims documentation. We are, of course, API ready. There are not that many insurance companies yet that have open APIs, but whenever possible, we integrate to their APIs and the APIs of the distribution channels that we work with. On the premium collection side, if it's a traditional insurance product, we would integrate with the payment gateway, a bank, a credit card. If it's on the microinsurance, so on the insurance for the low income, typically these customers do not have a bank account, so we collect the premium from their mobile phones. One example of that is what we do in Cambodia, where we sell life and health insurance to the customers of one of the mobile operators in the kingdom. And we collect on a daily basis very small amount of premiums. We're talking about approximately less than 1 cent US dollar per day. And of course, our platform offers a full analytics and reporting capabilities. There are a few myths that I will try to bust. So when the first time that we that I talked to insurance companies in the region, they normally told us, yo, this is too difficult, this is too expensive, this is not for me. It's not too difficult. So everything you saw is our platform is a very modular one. So insurers can choose and pick one or several of the modules that are accessible on the platform to customize the customer journey and the insurer operations and journey as they would like. It's also not expensive, and I want to thank Javier from AXA for his presentation of yesterday, which highlighted the benefits of a software as a service solution like Democrats versus a traditional enterprise IT. If you have any questions about that, please feel free to ask Javier. And the last myth that I want to bust is that, and I hope that we get to talk also about it during our next panel. Insurance in the region is very, I would say, traditional from a product and from a customer segment that are serviced. So there are a lot of players, but the products, they are quite, they're quite standardized. They're not that new. The customer segments, which is so 85% of them of the population in the Gulf do not have insurance. So a lot of insurers, they tell us, oh yes, these insurtech propositions in Europe and the US, they're great, but the market is not ready yet. And it might be true, but you always need to start somewhere. So there are two case studies that I brought today that shows a very of things that we do here in the region with quite traditional product proposition or channel propositions, and I want to show how our platform can digitize and basically achieve cost savings for the insurers. So the first one is for one of the largest non-life insurance companies, where we service 10 of their markets in the Middle East and Africa region on the personal insurance side. And this example is limited to travel insurance, so a product that we all know, that we all buy. Our platform has supported their sales on a multi-channel basis, so both from a B2B side, so when you go to a travel agent to buy your flight or to buy your holidays, they will also offer you insurance. Or when you go on the website of this insurer directly and buy insurance. So we offer a multi-channel proposition, so desktop, tablet, and mobile. I brought this example because this is one of the few insurers that have actually APIs. So when a travel agent or a customer quotes for a product, our platform directly calls on the dynamic pricing from the pricing engine of the insurance company. And when a policy is issued, we issue it directly on the system of the insurer. In this case, especially on the B2B, like with the travel agents, we needed a solution that is very simple and easy for them to understand. Travel agents, they don't have time to sell insurance. So our platform required no software installation. In less than 1 hour, and the travel agents, they started selling it. And I think these numbers, they're a bit outdated, but after 12 months, we have more than 95% of them that use our platform, and the policy keeps on growing. Moving to another product line, so to health insurance, something very, very, very common in the UAE, like in Bahrain, where group health is has become mandatory in the past few years. So here we work with the largest health insurance provider in the UAE, and we offer health top-ups. So what health top-ups mean is that if you go through the terms and conditions of your health insurance policies, you will see that not everything is covered. So you might have dental, optical, you might have health insurance abroad if you travel back home, or if you travel for holidays, it might not be covered. So here we offer on a customized per customer or per segment at least. We offer on a B2C basis any products that are not covered with. So if you're not covered with optical, we'll offer you optical. You're not covered with dental, we offer you dental, and so on and so forth. And this is quite interesting because the customer comes to buy the product from different channels, from the website of the insurance company, from the mobile app of the insurance company, from the SMS that our platform triggers for this individual segmentation, and also from social media. I forgot to add the social media. These insurers also sells on Twitter. The customer gets to our landing page and then completes his details, completes the beneficiary, enters his credit card details. In less than 45 seconds from the moment that he receives the first SMS, he has his policy certificate. And so working with a very, with a very large national health insurance company, also we help them to speed up their product development life cycle. So now they are testing 5 more new products per year than they were doing prior to Democrats. And we have observed that every new channel that we open up, the sales double. So now we have 4 of them, so these 3 plus social media. And so it's just a way to show how clients really expect from insurance the same customer experience that they're used to from any other industry. I think that's it from me. If you have any questions, I'm more than happy to answer them. Thank you very much.
Check. Is this okay? Thank you, Michele, for your valuable insights. Next up on our agenda is another distinguished panel of experts who will look at InsurTech and the way forward. Bringing us this session, please join me in welcoming the CEO and co-founder of LACA, Mr. Topias Taupitz. Also on the panel is the founding partner of EOS Venture Partners, Mr. Karl Bauer. The general manager of Istanbul InsurTech Hub, Mr. Andrew Warburton. The CEO and co-founder of Democrans, Mr. Michele Grosso. And the Chief Executive Officer of Hanover Reinsurance Group Africa, Mr. Achim Kleinert.
I think we're sharing chairs.
Should we just...
5 people, 3 chairs. Well, thank you for staying. I'm a bit biased because my full-time job is InsurTech, so I think this is the best part of the 2 days. It's been very enjoyable. Thanks for InsurByte to get us all together. So I'm the general manager of InsurTech Hub in Istanbul. It's my full-time job. And what we noticed in Turkey is that 1 year ago, they'd heard of InsurTech, but they weren't doing anything. So in this last 12 months, when I contact a general manager of an insurance company and I say, it's Andrew general manager of InsurTech Hub, now they want to talk to me. 12 months ago, they didn't want to talk to me. So why are insurance companies and reinsurance companies interested in talking about InsurTech now? Can I ask you, Carl, first?
Hello. Does it work? I think the insurance industry is discovering technology. Banking discovered technology maybe a few years before. I think the insurers are discovering that they're sitting on a lot of data which is underutilized. And the insurers are seeing that the emergence of mobile phone technology and big data is basically transforming their business. This trend has really emerged out of the European and the US market probably 6 or 7 years ago and is kind of gaining really every year, rapid acceleration, and we see the interest only growing month by month, year by year.
Toby?
I think it's fair to say that InsurTech is a very young term, as just mentioned. I think in the UK we have seen a wave coming 2015, 16 really, where you have companies like Laka, for instance, the same vintage year. Again, very young. We're breaking into really an industry owned by incumbents, and they're slowly warming up to us, ever more so. You have a great ecosystem that's being built up. Accelerators, I mentioned that, sandboxes left and right. And it makes it easier for startups like us. On the back of that, you see more and more talent flowing in, and most importantly, also the capital to make this all work. You have a very few very specialized VCs in the UK. The more generalists have still to do a lot of homework, but catching up. So I think it is here to stay. It's a young phenomenon, a young wave, and I think it just takes some use to get to each other.
Thank you. Akim, from the Africa perspective?
Yeah, I would say also that the insurance industry has in a way woken up that the young consumer is looking at different ways of doing anything that they do. The young consumer does everything on the mobile. The traditional insurance industry finds that difficult to integrate into their processes. I mean, it will come. It is. There's one saying that in the future, every insurer will be InsurTech, so the user experience will come along, but at the moment it's also an easy way for insurers to test and to play without spending too much money.
Yeah, Mihail, we first spoke a couple of years ago, so the InsurTech world's still quite small. Same question to you. Why are insurance companies want to talk to you these days?
Look, I think what you say at the beginning is actually very revealing. I mean, so when we started 4 years ago, so we're based in Dubai, as I said, and insurers by then, it was just they were curious about what we were doing. It was a breath of fresh air, but they really didn't get it. And then some of them, they were interested in this test and learn approach, and to trial and error. And now they actually realized, 4 years later, that it's either they evolve or they die. Especially in such a concentrated market like the UAE. And I think that yes, while InsurTech, that was born in the West. And with the support from guys like EOS, we come to see what's available in Europe, in the US, but the region has very different insurance needs, and that's what insurers they are now trying to understand and to tailor for, also by partnering with startups like Democrats.
Okay, thanks. I'm pretty well connected in the InsurTech world, and I did a survey on LinkedIn just a couple of weeks ago. And the question was, in the next 3 years, which technology is going to have the biggest impact on the insurance sector? So the three choices given were blockchain, which I think we talked about yesterday, artificial intelligence, which I think we talked about today, and also IoT, which probably connects everything together. So unbelievably, something like 20,000 people saw this post on LinkedIn, which is very unusual, and about 150 people actually voted, which is even more unusual. So I'm going to ask my distinguished panelists now, for you in the next 3 years, is it AI, is it blockchain, is it IoT, or is it something else? Maybe start. Yeah.
Definitely. So for us, we might be a little bit biased because we try to offer insurance to those who do not have access to it. So like with people that never heard of insurance at best or normally don't trust insurance, you really need to start from the basis. So I would say that something as simple as giving access to them via their mobile phone, so to be able to buy, to get to know first, to buy and to pay for, and to claim just using their mobile phone is something. Then of course we use, we use components of AI and also in machine learning now for fraud detection, but always with the objective of increase access and affordability to insurance customers.
Thank you. Akim?
So I'm probably the least qualified to talk about this topic, so I won't say much, but I think it's probably the intelligent combination, and each product is different, each customer segment is different, so it really needs to fit the business model. I don't think there's a one fits all type of approach.
Toby?
I mentioned it's a very young industry, and often people tend to have a solution and are looking for a problem. So in my mind, all these things mentioned are actually enablers that can come to great use cases. Some are more valid than others in my mind. We use bits and pieces where we feel like it aids our mission to change the narrative in insurance, a new business model. But again, we have seen a lot of buzzword bingo in the last few years, and again, it will be quite interesting to see the valid use cases with the right piece of tech, not the other round in my mind, to have for the sake of it any of them, and then you're looking for applications that way around.
Yeah, Carl?
I would only add, we as venture capital investors, we don't bet on one or two single technologies emerging. It's kind of tried to say, we are of course excited by the never-ending enrichment through big data, through complex data analytics. We think that from an investor perspective, blockchain, yes, is interesting, but is actually going to evolve out of microsystems, which are evolving out of certain kind of ecosystem, which will gradually broaden. We had some presentation yesterday from Hanover Re about their reinsurance solution, and I think that's going to evolve around that kind of pattern. We like the IoT business, and we like the IoT business not just for the retail business, but actually for the specialty and for the commercial lines. I think it's interesting to see that Munich Re has acquired an IoT business, which would have been, I think, totally unthinkable less than 6 or 7 years ago. People would have thought this would have been mad for a reinsurer to acquire. But actually, all this is an interlinkage of data enrichment and customer engagement. Ultimately, all this boils down to much broader partnerships between the insurance companies and the industry of partners around themselves. I think I like thinking as to what the car industry is doing. The large car manufacturers are producing approximately 20% of a car when it gets sold. The insurance industry is producing within the value chain maybe 80, 90, sometimes 100% or close to 100% of the entire value chain. I think that what you're going to see in terms of the technological partnerships and the data enrichment, the insurance industry is going to shrink to much more core services, and within that context, you're going to see that technologies in terms of partnerships, distribution, data enrichment, etc., is going to basically become modus operandi to a large extent in the insurance industry.
Okay, thank you. Yeah, I mean, we use this word disruption, and I suppose the disruption means change. And I actually started in the insurance business 31 years ago, and we didn't really have any technology, just a pen and paper. And there were 110,000 life insurance agents in the UK when I started, and today there's none. So definitely things are changing and change rapidly, and they will continue to change. What kind of a threat do you think Amazon or Alibaba, Facebook, Google will face? What impact could they have on the insurance sector in the coming years? Who wants to? Okay.
So I must say I find that a very interesting question, and it's interesting that it only comes up right at the end of the conference. We've talked about a lot of small startup businesses. We have not talked about the threat of the big tech at all, and I've been wondering on that for a long time. I think for most of the big tech companies, insurance is not that interesting, simply because our industry lives with margins that most of them wouldn't be even interested in. The big threat that I do see is, however, Amazon's business model is to thrive on small margin business. So I would definitely see them as a big threat if they are serious about insurance and they are expanding sector after sector after sector. It will get very, very difficult for a lot of the insurance players to compete with Amazon, which is, I think, another reason why it's important for insurance companies to find insurtech businesses that they can cooperate with and learn, so that they are in a better position to compete with Amazon should they decide to go that route.
Yeah, absolutely. Michele?
Perhaps I can bring an example of a pilot that we did with one of our clients, one of our insurance clients in Vietnam, that failed miserably. So with this insurance, actually, it was well thought. So it was a partnership with Facebook, but then the execution from a product perspective, it was not that great now in inside. So what they basically did is that they said they targeted a group of people on Facebook and say, are you interested in buying a personal accident for $100,000? Click here. And there were almost no sales. So this is to say, it's not that just by putting, an existing product and putting it on Facebook, it will sell. No. So you need to have, on one end, yes, you need to bring insurance to the channels that the customer expects. So being Alexa or Facebook, but on the other hand, you need also to customize it on the product side. On the other hand, so if for very simple products, yes, social media can be a good channel. I don't think that existing distribution channels like agents and brokers will die. No, technology can help them, but there will still be, insurance is still quite complex to understand and to crack. So you still need someone to explain it to you for the more complex products.
Okay, yeah, I mean, that leads on to my next question really, which is about agency and brokerage. And in Turkey is dominated by agency and brokerage, 80%. And I think that's true across Africa and the Middle East and actually most of Asia as well. So the experience in Western Europe is maybe different, and in the US they're going towards more digital sales. But here it's still very much dominated by the agent and the broker. Do you think that will change in the coming years?
I don't know about this. I don't know about this region. Look, ultimately, the winners tomorrow, and it straddles a little bit the question you had before, will be those who have access to data. Now, there's no reason why brokers or certain types of agencies or certain types of customer sources cannot have access to superior data. It's going to be more difficult for the traditional broker and for the traditional channels to have access to this data, but it's not impossible. I mean, each market functions slightly differently. I think for some of the important non-immediate customer fronting insurance businesses such as reinsurers, there's some fantastic opportunities because they have the risk management opportunity. They have the ability to understand and digest data and cooperate and partner with agents and with other intermediaries. I think that for those companies who are doing the traditional insurance business and who do not have access to data and who do not have partnerships and who do not have technology, life is going to become very difficult. Also because of the technological shift happening today, a lot of the traditional B2C business is going to shift into a B2B business. And if you just don't have the data, you basically do not have the raw materials anymore in order to engage with customers and offer products which eventually are going to change. The whole insurance product value change is going to change from a traditional protection to a prevention and to a prediction business. And without data, you're not going to be able to do it. You mentioned before, by the way, Amazon, etc. Yes, I think they're going to be a very big threat, but ultimately they're not going to be at the heart of managing the insurance risk. It's interesting to see what is happening in China. China has a kind of slightly more loose regulatory framework, has a very big market, has big critical mass. And when you see what's happening with Zhong'an and with Ping An, these companies are actually becoming more technology businesses rather than insurance companies. Zhong'an probably the most extreme example, but Ping An basically moving into ultimately tech and ultimately data gathering and data analytics business. And that's what comes back to your question as to can these players in these markets or in kind of slightly less big markets, maybe in this region, I don't know enough about this region, it's not because they're small that they cannot survive. They cannot survive if they don't have the right partnerships, if they don't have the right access to data, if they don't have the right access to kind of next generation customer engagement tools.
Akim, I'll ask you, is in South Africa, for example, is it dominated by agency and broker still?
We do have different business models and they all have found their place. But I think I'm coming back to what I said earlier. Unfortunately, nobody wakes up in the morning and thinks, wow, today I'm going to buy insurance. So it's the old saying that insurance is sold rather than bought. And that's the biggest challenge that I see for most of the insurtech businesses. How do we get distribution? Can I plug into existing distribution channels? If not, how do I build my own one? And that is very, very difficult.
That's a good question. So I saved the question to the two insurtechs. Same question, because obviously maybe your distribution method would be different. But I guess the millennials and these young guys are used to using smartphones and buying things. Do you think this is the future for you guys?
Definitely, that's bad for Laka. So I think brokers will move up and become more and more specialized, focusing on the higher value chain products, life and savings predominantly, and then you have commoditized products like car insurance, which we see in the UK, which is being sold 70–80% over online many price comparison websites. So why not focus your time and effort on products that are more value add? For us, it's the future, and the play is be fully digital, be available. I think there is no argument whatsoever that you need to call your agent to add another gadget to your policy. If you buy a new phone, why not add it real time? That's the experience you expect and want to have. Yes, we are a B2C company, and it's difficult. It's very hard to build up critical scale on your own. You can only pick up so many customers on your own via Facebook, for instance. So you want to find smart partnerships. B2B2C is probably then the buzzword where we meet all together somewhere in the center. And it's quite interesting to see how many tech companies nowadays are using insurance to monetize, right? Even if you take the Ubers of this world, a significant revenue stream is insurance commission and income, because they have a captive audience they're using then to buffer the loss-making core business sometimes. And the same now picking up on Amazon as well. Obviously it comes down to how much risk appetite they really have, managing the core balance sheet across various countries, doing it over and over again. I'm not sure if there's a lot of value add. If they want to get more than just being an introducer or a broker, when someone buys a gadget on the web platform, maybe yes, and that could be really interesting to see. And obviously also a big opportunity for us to break in. Nowadays you have companies like Allianz and AXA who buy up these partnerships, overpay very often to get the volume and access to it. There might be new forms and ways for younger companies like us to break in, which is really exciting for us.
Thanks. Michele?
Look, the UAE and the Gulf, they are, I think, quite similar to Turkey, so their market's highly dominated by pensions and brokers. And from paying back to what I was saying before, these distribution channels, they will not die, and of course they will stay there for a certain a number of products or customer segments that requires them. Technology can help to make them more efficient, so to make this distribution channel cheaper and more efficient. But again, those pensions and brokers, they're not needed for all the products and all the customer segments. I mean, if we go back to what Dr. Hilal was saying, and there are 380 million people across the Middle East and North Africa, less than 1% of the low-income population distribution has access to insurance. So I don't think that agents and brokers will be able to tackle them all.
Yeah, super. I guess that a related question is then, for example, in Turkey, in the pension sector, life and pension sector, the conservation and persistency and loyalty rates are much higher if the product is sold through an agent than if it's sold through bank assurance or any other alternative distribution channel. So moving forward, if more product is going to be sold digitally, that should suggest then the lapse ratios will be higher, because maybe you're not touching your customers as much. What will happen in the future? How will we be able to keep conservation rates high when there isn't maybe an agent involved? Carl?
It's a good question. There will always be highly commoditized products, and car insurance is probably a good example. This being said, the application of technology is all about moving the customer from this kind of traditional protection business to a preventive and to a predictive support. The more you can, as an insurer, provide the support, the more intrusive you become in his or her life in order to kind of provide in a constant way, not just the product support, but actually everything which goes around, the lower the lapse ratio, the higher the persistency. And I think that's going to be a big battleground. In my mind, there's no immediate correlation between the more digital you go, the faster the client is automatically going to move. If you don't provide any of these add-on products, and that's where all the big groups are going to focus on, i.e. enriching this customer engagement journey, then of course, yes, it's going to be tougher. But otherwise, I think it might actually even bind more the client going forward.
Toby? How do you keep your clients if you're not touching them every day?
We speak to them very often, very frequently. So as mentioned, people can access our platform, add new parts and gear and value real time. We have probably 20-30% of our customer base having at least one touch point a month with us. On top of that, we send out a monthly bill where we can push out some content, smart advice or not smart advice, or any promotions we have, or any tips for safety and whatnot else. So I think the big chance for us is in that regard, instant interaction and more touch points and the annual renewal date, which is often claimed. It's our job to figure out how to explain the product in this new world in different terms. The regulator is playing its role. In the UK, we have now the IPIT, which is giving a customer a product fact sheet, which probably helps already for those who are not keen on reading through policy wording, a summary almost. But again, it's a big opportunity for us to become better in describing the services offered. And there's still a lot of horrible examples where people think they are covered and they are not because of loopholes or didn't understand it properly, or it was cascaded in a way. I think it's a two-way road. Again, the future is interacting more with the customer, and whilst realizing, recognizing they might not want to hear from you on a daily basis. But if you can find incentives that they come to you, I think that's really interesting. One example probably being Vitality is often mentioned in the UK. They do very well in gamification. If you track your steps on a daily basis, they give you some rewards. And it leads me to going to a pharmacy to have my cholesterol checked because I want these extra 100 points to make to the next tier. So I proactively access the app without them asking me for it. I think that's really powerful. Gamification will play a big role, proactively collecting the data instead of passively asking for it.
Yeah, thank you. Akim?
Yeah, I would agree with the previous speakers that increasing the number of touch points is definitely key to success if you want to digitally distribute. So you must find ways. But then I would also say that the insurance industry is actually quite lazy. I mean, when last did we think of new products? Really new products. So I'm approaching 30 years in the industry now. If I really reflect in non-life insurance, what have been really completely new products? Cyber insurance is probably the best example that comes to mind. That was developed in the last 10 to 20 years, somewhere there. And then that's why I'm so excited about the Investure product, because it's really something that is brand new. How often do we think, what is really the worry of our customer? Yeah, we sell them the same fire policy that we've sold for 200 years. Is that really the prime worry of the customer? Or is it not maybe the exposure that my children have in the digital world? And how can I best ensure that? That's what keeps me up at night. If the house burns down, it's bad. Of course it's bad. But is that my biggest worry? No, it's not my biggest worry. And I think we should apply our minds more towards what the real worries of our customers are, because if we can address that, then we shouldn't have a problem creating customer loyalty.
Absolutely, I agree. Mahela?
I completely agree too. So if we bring this to, to more emerging customers, if you want, the example I gave before of Cambodia, where we sell this monthly policy with daily or weekly collection period. So there the lapsation is quite high, not just because the people more often than not do not have a credit on their mobile phone, on their prepaid SIM card. But interestingly enough, we see actually quite a strong correlation in between the number of claims or customers that we think know that a claim happened because it happens in the same community, and the persistency of the products, which brings back to the fact that to the product value question. So you need to give to give customers what they actually need and what keep them awake at night. I mean, from the lower end of the spectrum, especially if they have a spending power of a few dollars a month, they're not gonna. If you hard bundle a product on them, at the moment they realize that they're paying for something that they didn't know about, they will lapse, of course.
Yeah, thank you very much. So, for me, InsurTech, although it's a huge area, a wide area, there's so many different aspects to it. As a consultant and general manager of an InsurTech hub, I find the insurance companies have basically want to use InsurTech for three things. The first thing is they want to reduce their costs one way or another, whether that's either speeding up, needing less people, or cutting down claims, fraud prevention, etc. The second reason is to distribute new product or more product in a different way. And the third one is to keep the customers they've got, because it's more profitable to keep a customer than it is to find a new one, as we know. So just out of those three things, which do you think is probably going to have the initial impact for maybe our colleagues in this room? So is it to save costs? Is it to increase distribution? Or is it to keep your profitable customer?
I think that, shorter term, of course, it's to create better customer engagement. The holy grail for us venture capital investors is ultimately, and this is a holy grail, so it's not achievable, is to actually find a way to reinvent insurance pricing, risk assessment, away from a traditional, actuarial approach, i.e. rethinking entirely risk selection, risk pricing. That is at the core in terms of the biggest impact, but that is only going to come over time. That requires a lot of AI, requires a lot of data. Shorter term, definitely for us, distribution, customer engagement. Immediately thereafter, claims improvement, claims reduction. It's interesting that less than 5% of the InsurTechs, of the approximate 1,800 InsurTechs, they are outside there. Less than 5% focus on improved claim management. Claims processing, claims management is complex. The whole process from F0 down to kind of paying it out and closing the case is a complex process. Hence few companies, but there's an enormous potential, absolutely enormous potential. This is the biggest cost base for an insurer. And then longer term, rethinking, reinventing pricing.
Same question, Toby?
I don't think competing on price is the way to go. We've seen it in the UK where insurers get commoditized. If you just compete on low-level service to save better margins or low price, that just erodes in brand value. So I'm hoping to see that it reverses in the UK again. Customer engagement, or I think the buzzword in my mind nowadays is value-added services. What else can you offer them? Can you insure the bike? Can you finance the bike, for instance? Can you extend it to warranty? Can you find good servicing plans alongside? How can you monetize multiple times whilst you offer a real value-add service to the customer? I think that's a real interesting question for me we are trying to solve.
Thank you. Akim?
On the value added, I think in South Africa we refer to value added products most of the time. I must admit that I've got a skeptical view on that because I think a lot of that is actually value destroying products. If you look at products that are being sold and the loss ratios there, they are such that I would argue that most of the time the customer actually doesn't get value for money. So what excites me personally the most is really new stuff. Stuff that hasn't been there, whether it's a different way of doing it or a completely different product. And I really think, there's so many intelligent people in this industry, we should be able to generate more products than what we are actually doing.
I agree.
Maybe just to chime in, when I say value-added products, I mean the non-insurance side of things, so anything but those services you mentioned, are probably good to clarify that up.
Okay, Mahela?
Look, I think that the first rationale that insurers are looking for when they talk to us is still less saving cost. And it makes sense, only because that's their priority as of today. But we see, and this is the thing I'm most proud of, with all our insurer clients, and I mean, I will bring the example of our first client. So this large P&C company that we work with, that when we started to work with them 3 years ago, they had no interest whatsoever in microinsurance, emerging consumers, really not their cup of tea at all. So we started on their traditional customers and traditional distribution channels. Now they offer through our platform products that cost less than 1 dirham, is less than $20 per month, and they started in the UAE. They just replicated this to Bahrain, and we're going to announce something very exciting for this market with them and one distribution partner. So that really proves our point that the technology, that a platform like Democrats can help them to access new customer segments and new products that they couldn't have done before.
Okay, so the title of this was InsurTech, the way forward. So hopefully we've given you some our point of view on some of the ideas that we've got. I think the important thing is you've got to do something, because if you don't do anything, you're going to be in trouble. And I think everybody on this stage is worth talking to get some more information and more guidance. There's a lot of experience up here, but a mixture of age and young brilliance. I don't know, do we have time for questions? Yes, maybe 1 or 2 questions. Do we have time?
Thank you very much, guys, for your time and for putting together this panel. My name is Ali Zayer. I'm from Solidarity Bahrain. And as you rightly said, Andrew, now we are talking about the way forward, especially here in Bahrain and in the region, in GCC in general, right? So I just need 2 minutes, if you don't mind, because I have 2 questions that I would love to receive answers on, if you could kindly allow me. Is that the current situation here in GCC, and especially in Bahrain, is that yes, there is intention to definitely embark on the InsurTech and digital transformation journey and the InsurTech adaptation. However, there are some challenges. One of them is the readiness of the receivers, of the customers, in terms of, because of the challenges regarding the cultural challenges or the fact that certain products are optional. Most of the products are optional and very few are mandatory. Another challenge could be the legacy systems. That good news we have is that they are being revamped now. We are heading towards having systems that are enriched with more APIs that can be eventually used and utilized later for new adventures. And the basically third challenge that we are facing is that we have this understanding here in Bahrain and also in the GCC, is that if we want to embark on InsurTech journeys, that might require huge investments. And because of the understanding that we have could be wrong, is that the market is still not ready, it might not be, it might not worth it. That's the challenge that we have now. Having said that, we have 3 questions, or 2 questions I would say. Question number 1 is that, Andrew, you come from Turkey, and apparently Istanbul has pretty mature, it has maturity when it comes to InsurTech and the application of these initiatives in Turkey. What is the best way forward here in order to bring your model or any successful model to Bahrain? Okay, that's the first question. Another question is, I don't know whether it's worth going for R&D or whether we have to do it in silos as companies. Companies want to embark on these journeys. Shall they do it in silos or form consortiums or some kind of alliance to do more and more R&Ds, and based on the results, we move forward? So what are your thoughts? That's it. Thank you very much, guys.
Well, I can answer the first one and I'll hand over the second one. I don't think Turkey is very different from the Gulf region in many ways. And yeah, we have lots of insurance companies. They've been there a long time, but they haven't really invested in new technology. And the issue is the insurance companies are not so profitable, therefore they don't have the money to invest in new technology. And that's the reason why we've set up the InsurTech Hub. So the idea is we bring a community together with all the insurance companies and startups and software companies and assistance companies, anybody that's touching the insurance sector, because we've got 50 motor insurance companies in Turkey. They've all got the same problem. They've got fraud in motor insurance, for example. So for each of those 50 companies to invest in software for fraud prevention for motor, it's individually very expensive. But if 10 or 12 come together and say, okay, this isn't competition, this is the same problem we all have, it starts to reduce the cost for each company. So I think that's what we're trying to do here, and I think that would also work in here. There's a tradition that insurance companies see other insurance companies as just the enemy and the competitor, and we can't work together. And maybe on developing new product and maybe distribution, that's true. But on things like operations and fraud prevention, it's not true, because you've all got the same issues. So my suggestion is, something similar, some kind of InsurTech hub in this region would be a really good idea. And to be fair, I think this is what this forum's about. Maybe this is the start of something similar, where I don't know about Bahrain. I can talk about Turkey. We went to the Insurance Association in Turkey. They agreed that InsurTech was great. They wanted to be part of the future. They wanted to be involved. And at the same time, they wanted to kind of preserve the status quo a little bit. So I hope politically I'm not standing on any toes, but I think sometimes it's better for the insurance companies to get together to solve their problems than sometimes using a central body. I have no idea about Bahrain. It might be completely different here. It might be different in Dubai. I honestly don't know. This is just what we found. So yeah, have like-minded people speaking together may solve some of the problems. The second question was, can you repeat the second question? For R&D. Maybe Hanover Re, because I guess you're involved in it.
So maybe not either of those. So what has worked extremely well for us, which has resulted in some of those startups, but also into a big cultural change within our organization, was actually a competition that we hosted, where we recruited young people with little experience, with little work experience, put them through a structured program where we facilitated insurance and reinsurance knowledge, and basically asked them, come up with ideas and bring them to a level where we can actually decide whether we want to invest into those businesses or not. It was called Journey Re. Pineapple and Investure are direct outcomes of this competition. But as I said, it's not just those businesses that came out of it. It also changed the mindset of the organization in a big way. So a lot more people in our global organization are now open-minded to talk to new startup businesses, to come up with ideas. We are following up as we speak now with an intrapreneur competition, where globally people were asked to generate ideas, and they will go through a process where we filter it down to 5 ideas that eventually go through a slightly longer process, and then they can build an investment case. And it's a fantastic way of actually starting your own business. So a competition like that has got the advantage that it's time limited. The investment that you need to put together is limited. If absolutely nothing comes out of it, you haven't lost much, and you would have learned on the way. So I really can recommend thinking about those type of things.
I can maybe bring the example of the UAE. So on 2 of your points, so I think before assuming that InsurTech, that specific InsurTech solutions are too expensive, I think you should talk to a few of them. So what I was showing and what Javier from AXA was showing is that the cost advantage of this software as a service in the solution versus doing it in-house was just talking yesterday to the CEO of one of our clients, and I mean, he was saying, look, what we're used to is working with these IT providers who charged us $2,000 to change one word in one of the TNCs. This whole new model that you're bringing, is much more convenient. So I would say first talk to a few of them. And in terms of how to do it internally, so we have worked with two models. So one where the insurance company, the business team, has a business need and builds up a business case and a way forward with us, and then bring it to IT and to management. And the second one where the innovation team puts us under their arm and then builds the business case for the business. I think it works a little better the first, so where there is a clear business need that you address together with the startup partner.
We have a vested interest as venture capitalists to invest in companies where we think that actually they can maximize cooperation in business with established players. So it's very important for us to understand not only the kind of type of business in which we understand, but how they can interact with the companies. And my few observations on that are the following. First of all, successful innovation in an insurance company, frankly in any company, is not technology, it's a mindset. You do not start innovation with technological investments. You start innovation with actually senior management being open to an idea of change. Point number two, in the insurance companies, it never works if you are overly ambitious and basically start wanting to innovate right, left, and center with complicated IT budgets, with reorganization. It usually leads to disaster. Where we have seen it, and I'm not talking about gigantic organizations now, like Travelers or Allianz, etc. They're living in a different world. Where we have seen things work well is actually a company finding internally one or two important areas of the business, with the willingness of one or two board members to actually push change through, taking some younger, smart, ambitious, motivated people, and basically go off with a pet project and improve certain important aspects of this one or two business lines. And if that works, you actually have an avalanche effect, because the other areas of the business will notice how successful this is, that customers are kind of, sticking around, that there's a new product, whatever that is, and that you then build a gradual change through the organization. Yes, you have to take a certain risk. As Michele said, you have to learn how to engage with these companies, with these small insurtechs. And it's good to do that with one or two, not immediately with 10 or 15.
And just a final point, yes, most insurance companies in the world have got legacy software. This isn't a problem in this region, this is a fact of the whole world. But the point is, this new software these guys have got on here can connect to it. And it's not as expensive as you think. And I'm saying that as an independent, I don't work for insurance companies. I'm somewhere in the middle, I'm the bridge if you like. And you would be amazed the solutions are not as expensive as they used to be in the past. So the fact that you've got a legacy software platform doesn't stop you taking advantage of InsurTech, definitely not. Any more questions?
Hi. My question is regarding working with startups. So you've mentioned insurtechs and let's say health techs, for example.
Sorry, can you just speak a little bit louder? Thanks.
Yeah, regarding working with startups. So corporates, if they want to invest in startups, for example, what are the challenges that we can expect here and what are the solutions?
I could probably give an example of how we are working with Zurich in the UK. It was quite a unique situation that we were there first to work together. There were a lot of hurdles, mentally, I guess, on both sides. So maybe losing the word investing, because you don't have to invest to work with a startup, invest in your own resources to free up some time. I think, yes, it's necessary. You don't need to buy equity into a startup to work together. I think for us, of course, we are fighting against the clock. Any week or month of delay could cause harm. And we want to run at 1,000,000 miles. Well, you have obviously your own schedules and timelines you have to adhere to. Different departments need to get brought in. And that was a big obstacle for us, because very often in the UK we have now seen a new role emerging, which is a head of innovation who ran out and wanted to really do things, but then brought the lucky idea to the head of underwriting, who said, hang on, what's this? And then you had the head of compliance, the head of agency, the head of marketing, and et cetera, to bring in and get people on board. So a few companies have done very well building a small task force internally, knowing from all departments those who are a bit more open-minded on the underwriting side, on the actuarial side maybe, and in other important parts to have, to work on an eye level and a quick pace, I guess. And I think going into this is really helpful, because it is quite difficult for a startup where you need to create proof points constantly. You have to constantly convince investors, look, Carl, we've made the next milestone, hooray. And at the same time, you're working to the next board meeting, which might be only 3 months' time at the insurance company. So finding a way to accelerate that journey internally in whatever shape or form will really, really help to level the playing field.
Again, for us investors, when we invest in a company, we also want to make sure that actually the partners with whom they work are able to accelerate growth. So what we've seen in the insurance industry, the insurers, it's a traditional industry with a traditional culture, with a traditional regulatory environment. It's an industry and it's an organizational setup which doesn't really like to take risks. I think that the way you maximize your cooperation with InsurTechs is that you actually have this innovative framework where you are willing, as part of the innovation, to take a certain risk that things may not work exactly out the way you want, and that the organization accepts that. Because otherwise what happens is you suffocate to death an InsurTech. You can kill an InsurTech corporation within a few weeks or a few months. It starts by sending to an InsurTech a non-disclosure agreement of 400 pages, which typically you would send if you work with IBM, but not with an InsurTech. So there needs to be this mental shift. I'm actually going to try something new. I am not sure whether this is actually going to work. But out of the experience and forcing the internal organization of thinking differently, I will actually learn. If an insurance company is not having that mindset, it will probably kill the cooperation pretty quickly and will not learn anything out of it.
Yeah, so from our experience, it's a fine balancing act because insurance is a sensitive matter, like health is a sensitive matter. So the concept that works in many other industries of a minimum viable product, I strongly object to in the insurance industry. You need to bring something out that really works and is solid. Otherwise, you're being unfair to your customer. So on the one hand, you need to define what are the things that you as the insurance partner need out of that, and I think you must be actually quite inflexible about those criteria that you need to have fulfilled, because ultimately it's your name in the market and your name with the regulator and so forth. On the other hand, almost everything else, you need to be prepared to be uncomfortable. And you need to be prepared to be challenged in your thinking, and you need to adapt. Our experience has largely been with, let's say, millennials, and if you want to manage them in their startup, in the way you manage your normal department within an insurance or reinsurance operation, it's bound to fail. So if you voice your expectations clearly, these are the things that we need to have ticked off, otherwise we're not moving forward, but then almost leave the rest to them. And you'll be amazed, I think it's become almost the norm to complain about millennials. I don't get that. I've never had so much fun in working with people as in the last few years, because they always find new ways. I mean, you hit a brick wall one day, you discuss something, you think, there's no solution to this. I think we might have come to the end of the road, and you meet with them again 2 days later, and they've found a way. So be prepared to be uncomfortable in the process.
I think, with fintech, basically let's open banking, and the technology has completely changed in the banks because of this. InsurTech's the same thing. You're going to outsource a lot of your innovation. This is because it's cheaper, it's faster, and you can get results faster. But you have to have that kind of innovation culture inside your organization, because insurance is very conservative and very traditional. So I think the first thing to do, if you haven't done so, is get that innovation department set up in your company and start having a we can instead of we can't change, because I think you must do that. I think we're done. Thanks, guys. Thank you.
Thanks to our distinguished panel of experts who have highlighted inspiring future concepts for the insurance industry today. I think we can all agree that InsurTech is definitely the way forward for the insurance industry. Based on all the discussions that went around today, we are pleased to present to you a program from the BIBF entitled Digital Transformation Program, which is a 3-month program on a part-time basis, which sheds light on the latest emerging technologies and concepts that were covered during the last 2 days. And it's open for all roles, not just the technical IT side, but all roles within companies. This program is also supported by Temkeen. Furthermore, Bahrain FinTech Bay also brings you the Georgetown University FinTech course, which is a 12-week course which also equips you with the knowledge to become a certified FinTech professional. And finally, we come round to the end of our inspiring sessions and amazing ideas, and we thank all the experts and all who have joined us today. We hope we have inspired you by the proceedings of InsurByte 2019. On behalf of Bahrain FinTech Bay, the BIBF, and the BIA, we have been honored by your presence, and we hope to gather in more conferences and events in the future. Lunch is served in the ballroom next door. Thank you all and enjoy.